Alexis Mills alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures are lower following Tuesday's sell-off triggered by weak manufacturing data, rekindling fears around the health of the U.S. economy. The S&P 500 clocking its worst day since early August. So let's get into it with the three things that you need to know to start your trading day. We've got Yahoo Finance's Inez Ferre, Alexis Keenan, and Brooke DePalma with more.
And U.S. stock futures are lower as Wall Street tracks the effects of Tuesday's big sell-off. The Dow dropped 600 points, the Nasdaq Composite dropped more than 3%, and the S&P 500 fell 2%, its worst day since early August. The sell-off pegged to weak manufacturing data as traders brace for a potentially volatile September, a historically weak month for stocks. Wall Street is looking to the next test of the markets, JOLTS data, which will give investors a fresh read on the health of the labor market ahead of that big jobs report on Friday.
And NVIDIA was one of the biggest laggards in Tuesday's sell-off, sliding around 9.5% and shedding $279 billion in market cap. That's the largest single day drop in market value for a U.S. stock. And shares extending those declines ahead of the open this morning after Bloomberg reported that the DOJ sent subpoenas to NVIDIA and other companies as it seeks evidence in an antitrust probe. According to the report, officials are concerned that NVIDIA makes it difficult for customers to switch chip providers and that it penalizes buyers that use other chip manufacturers. NVIDIA saying in a statement to Yahoo Finance, NVIDIA wins on merit as reflected in our benchmark results and value to customers who can choose whatever solution is best for them. The DOJ, for its part, declining to comment.
And the U.S. consumer is in focus today after two big retailers give us an inside look at the state of the consumer. Dollar Tree plummeting after lowering its full-year guidance. The company missing on both the top and bottom lines in its second quarterly results. Dollar Tree attributing the results to the effects of macro pressures on the purchasing behavior of middle and higher income customers. Meanwhile, Dick's Sporting Goods also out with results this morning, beating on both the top and bottom line and raising its full-year guidance, but Wall Street wanted more. And it felt like the outlook was a bit too cautious, but we're going to get an inside look at the state of the U.S. consumer all day long here at the Goldman Sachs Retailing Conference, where Yahoo Finance will be live on the ground.
Good morning, everyone. U.S. futures extending their losses from that big sell-off Tuesday and a brutal start to September here. And as we're taking a look at the Dow, the S&P 500, and the Nasdaq futures red across the board. However, take a look at the tech-heavy Nasdaq. As of right now, it's lower by about 0.5%. Why, you might ask? Well, NVIDIA, one of the biggest laggards of the day, the AI heavyweight stock, fell more than 9% on Tuesday. That decline wiped out $279 billion from NVIDIA's market cap. That is the worst ever one-day market cap drop for a U.S. company. NVIDIA shares are sliding further in pre-market trading, as we've been tracking here, Maddie.
Yeah, it's interesting to see that pressure kind of continuing on NVIDIA, but I do want to take a look at our Wi-Fi Interactive to look at those broader semiconductor names. So you got all your semiconductor stocks here showing the close on yesterday. You've got NVIDIA, the biggest laggard, down 9.5%, but you got TSMC and Broadcom competing for the second biggest laggard position here. And you can see in the extended hours that some of these names are starting to recover ever so slightly, but I mean, it's really a sea of red. But you've got AMD and SMCI recovering a bit, so we'll get to the reasoning behind that when we talk a little bit more about those names later in our show. I do want to flip the board over, though, to the full screen that we have indicating the consumer stocks that were not necessarily struggling alongside the broader sectors yesterday. Here you can see the biggest sector laggards in the closing bell as of Tuesday. You can see information technology leading the way in terms of downside pressure, down nearly 4.5%. You've also got pressure on comm services, energy, industrials, and materials. Brad, the only two sectors that were in the green yesterday were consumer staples and real estate rather, which to me indicates a little bit of a risk-off sentiment amongst investors.
Certainly. All right. Some of that outsized impact really driven by NVIDIA impacting information technology. As you mentioned, let's stick with NVIDIA and that rough 24 hours for a hot second here. We are seeing the stock extend some of those losses. As we mentioned, Bloomberg reported the Justice Department sent NVIDIA a subpoena over possible antitrust violations. We've got here with more Yahoo Finance senior legal reporter Alexis Keenan. Keenan. Hey, Alexis, what do we know about this so far?
Hi, guys. Yeah, so it wasn't just NVIDIA, it was also some other undisclosed companies. This comes from a Bloomberg report citing sources familiar with the matter, saying that the DOJ wants to subpoena information from NVIDIA. We don't know at this point if that is a subpoena for documents, for testimony, for both, but we knew that the government was interested in looking into the company on antitrust grounds back when a report from the information came out saying that there were customer complaints over NVIDIA's penalizing reportedly buyers who are not exclusively using the company for its chips. And we should point out here, though, the thinking is that these are the GPU chips, not the video component chips that NVIDIA of concern to the DOJ here that power the data centers. So just to make that distinction. And also customer complaints reportedly that the company was making it hard for chip users to switch companies. NVIDIA makes the CUDA chip programming software. So that is what the thinking is the concern here. Now, let's point out, too, it's not illegal to have a monopoly, certainly at this juncture, and NVIDIA has a monopoly in this market. But what is illegal is to use that monopoly, to use tactics in order to hold on to that monopoly. So the DOJ wanting to take a deeper probe here, and also under antitrust law, it's not okay to price discriminate when you have customers operating in the same market. But there are some exceptions to that rule that can happen when market conditions are rapidly changing. And certainly you can imagine over this past year with the demand for these chips that NVIDIA could make the argument that the market was rapidly changing. There are other conditions like price matching when competitors drop their prices. Maybe that's not so much an issue here. But looking at competition, at least on U.S. grounds, you have NVIDIA out there in front with something around 80% market share at this point. AMD, Intel thinking to be far behind that stage at this point here. Also, this CUDA chip programming software, what it does is it allows NVIDIA to make GPUs run more efficiently, the AI apps run more effectively. And the thinking is that could lock in customers because they've got the hardware and the software side. And sometimes, as you've seen in some of the big tech antitrust cases, when you tie a lot of products and services together, that does raise eyebrows with antitrust enforcers.
All right, Alexis, thanks so much as always for breaking that down for us. We really appreciate it. Let's hone in on NVIDIA's historic slide on Tuesday, posting the single biggest market day cap drop for a U.S. stock. Pressure on NVIDIA worsened after the Department of Justice sent subpoenas to the company over antitrust concerns. That's according to reporting from Bloomberg. Here with more, we've got Patrick Moorhead, More Insights and Strategy founder, CEO, and chief analyst. Patrick, always a pleasure to get to speak with you. I want to start on this news out of the DOJ here. What exactly did NVIDIA do wrong?
Yeah, so first of all, as your previous guest said, it's not illegal to have a monopoly. It's illegal to use those monopolistic powers to hurt consumers, reduce innovation. And NVIDIA has over 90% of the data center GPU market. It is technically a monopoly. And in a hot market and an important market to society like AI, that just sends off red flares out there. And the last 10 years, and if particularly Lina Khan administration, there's a new look at even pre-prime. It's not what you've done, but what you could do. Now, what's coming out of Bloomberg is clearly of what happened, right? You can't tie products together. You can't tie gaming products to data center products. You can't retaliate. You can't give exclusionary rebates. So for instance, don't buy AMD, or if you do buy AMD, I'm not going to give you this discount. And finally, this was discussed a little bit, one of the moats that NVIDIA has is their software called CUDA. And as we saw with Apple, if you are blocking competitors interfacing with that, that is a no-no.
And so is this now kind of filling in some of that moat that they have? If this is successful in the subpoena that's come forward and ultimately what that means for CUDA, if there has to be some type of licensing agreement that they offer up to other chip manufacturers?
That's exactly right. Now, the challenge here for the competitors is these are always a 10-year affair from the beginning of a complaint to a verdict to even some type of appeal, you can get the courts to come in and force something if there are smoking guns, sort of a cease and desist. We saw this with Apple and the EU. And the second risk here is these are infectious, right? What happens is other jurisdictions, let's say the EU, Korea, Taiwan, other areas of the world, they see the DOJ doing this, and it gives credence. I do expect these complaints to pop up in other parts of the world.
Well, Patrick, I would be remiss to not talk to you about the stock performance while we've got you. So obviously a historic day for NVIDIA in terms of downward pressure on the stock here. Looking ahead, what needs to change? What can Jensen Huang and the company be doing to turn the stock story around as we head into the next quarter here?
Well, if Jensen can change the recession and the fears of that, which of course he can't do, that would make the biggest difference. The reason for the sell-off yesterday wasn't necessarily from this report. It was based on more fears of recession. And as we've seen, what can go up a lot can come down, and often does. And AI, it's why AI were the biggest decliners. So any type of hiccup brings this down. I think a real rate cut, as opposed to hints of a rate cut, and potentially other good signs of an economy on the rebound will bring this back. But it's really, I think investors know, particularly institutional investors, that any type of Department of Justice ruling, I mean, my gosh, this takes a decade. What NVIDIA can be doing is to continue to have the highest performance computing in the data center to solve the problems of the hyperscalers and the enterprises and the tier 2 CSPs.
So, Patrick, you would say that the headwinds for NVIDIA are more focused on the macroeconomic challenges than even, say, Wall Street's expectations or the valuations around the stock?
I would say the stock price is absolutely, but when you look at the growth, the 100, 200% growth, this is all about delivering Blackwell on time, like Jensen said on the call, doing that with the highest level of compatibility with the best yields that has a positive impact on costs and hence margins.
It might be an unfair analogy, Patrick, but I mean, this gives me the vibes of what Microsoft went through in the late 90s, early 2000s, especially as there was so much rapid innovation within software, and Microsoft was trying to make sure that it could stave off competition and grow out its business. Now, we saw what happened in the stock thereafter. We saw the legal proceedings that played out. How much of what's happening with NVIDIA right now is analogous to what took place with Microsoft, and for investors to try and draw comparisons right now?
When Microsoft was put under the microscope over 2 decades ago, it was like putting sand in a gas tank. It slowed the company down. It slows every company down. You literally have to get legal approval for pricing. You have to put it in writing. Everything you say is going to be captured. It fundamentally slows a company down. I don't believe, like Microsoft, that the Department of Justice would try to break up NVIDIA like it tried to do. And by the way, it did get a ruling that it did need to get broken up, but that was reversed on appeal. But NVIDIA needs to very much watch what it's doing. And what's interesting is you always have complaints. And I think the complaints that we will see later who came forward is more than just direct competitors. I also believe these are likely some of NVIDIA's largest hyperscaler customers out there. Quite frankly, nobody is comfortable out there with NVIDIA having 90% market share out there.
And so with that in mind, just briefly, is it an AMD that perhaps is best positioned to be one of the other companies that both investors and customers start to look towards as an alternative to NVIDIA?
AMD is the next best replacement, particularly because they both have GPUs, followed very closely by Broadcom. The counter to a GPU is what's called an ASIC, and those are primarily built by Broadcom, and they supply Amazon, Microsoft, Meta, Google across that. And an ASIC is more efficient than a GPU, but not as programmable. In 25 and 26, I would say Intel will likely be a factor with their GPU-based designs.
Patrick, always a pleasure to grab some of your insights here with us this morning. Thanks for joining us ahead of the opening bell as we're all tracking NVDA this morning. It's Patrick Moorhead, founder, CEO, and chief analyst over at More Insights and Strategy. Thanks, Patrick. Let's get a check now on commodities, starting with oil. Oil prices are lower, giving up gains from earlier in the session. Reuters reporting that OPEC Plus is discussing a delay in the next month's scheduled output increase. Here to discuss further, we've got Yahoo Finance's Inez Ferre. Inez, there have been a ton of moves around oil, whether it be OPEC Plus this week or even the Libyan oil production here. What's really having the more outsized impact?
Yeah, that's right. And we saw oil really plunging yesterday. And we can take a look at our Wi-Fi Interactive because you can see that now oil is flat year to date. So it has erased all of the gains for this year when we're talking about WTI year to date. You can see the chart there. And Brent crude down 3% year to date. So part of the reason why we have seen oil just plummeting recently is because of reports that Libya production that you just mentioned, that may come back online because there may be a solution to that internal dispute in Libya. So you would see supply coming back online there. And then you have these looming extra supply coming from OPEC Plus. And now reports that OPEC Plus may be delaying adding on barrels in the fall because of these collapsing oil prices. An analyst just wrote to me this morning saying that he wouldn't be surprised if OPEC Plus delays that measure. Remember that those were voluntary cuts that were going to start to be rolled back in October and through 2025. Well, because of these prices, OPEC Plus may not have any other choice but to delay that. I do want to mention that gasoline futures, by the way, have been at 3-year lows. Gas prices are at around March levels, but gasoline really plunging. And this analyst telling me that you could see gasoline prices going down to an average of $3 per gallon by the end of the year. There's already 9 states that have the prices at below $3 per gallon. And then finally, I just want to mention what's been happening with some other commodities as well. Gold holding up at around the 2,520 level, and copper stabilizing this morning after yesterday. It was down more than 2%. Goldman Sachs cutting its forecast on copper for 2025, citing weak demand from China. Guys.
All right, Inez Ferre, thanks so much as always for joining us. We appreciate it.
Thank you.
Well, shares of Dollar Tree are under pressure in pre-market trading, down nearly 13% here. The discount retailer cutting its full-year sales forecast after disappointing second quarter results, adding to a growing list of retailers citing a struggling consumer. Let's bring in Brooke DePalma with more. And Brooke is live on the ground at the Goldman Sachs annual Global Retailing Conference. Brooke, we'll get to the conference. I know you've got a lot of exciting interviews coming up. But first, let's talk about Dollar Tree here, because this feels like just the latest in a list of retailers I've been asking you the same question about. But what stood out to you about this particular print?
Good morning, Maddie. That's right. Dollar Tree shares falling as much as 17.5% in pre-market trading as investors are really digesting yet another retailer to cast a cautious approach to the second half of 2024. Taking a closer look at those key metrics that Wall Street looks at, revenue, earnings, and same-store sales growth missed across the board. Revenue came in at $7.37 billion. Adjusted earnings came in at just 67 cents. And same-store sales also came in below, up just 0.7%. Executives saying on the call some key insights here, saying that Family Dollar's core lower income consumer remains weak. Dollar Tree did post same-store sales growth of 1.3%, but even the company said that was lower than expected as their middle and upper income households were hit by inflation interest rates and other macro pressures, and that was the primary driver of their revised full-year outlook. One thing important to note here as well, I thought it was really interesting that executives pointed out on the call that shrink remains unacceptably high. They also added that it appears to be stabilizing, but it's too early to declare victory. We also know that Dollar Tree has been implementing multi-tiers, more higher-priced goods, and they're navigating how to adapt to shrink there as well.
All right, Brooke, let's turn back to this conference that you're at. I mean, what is on the docket? We know some amazing interviews are going to be coming your way from that Goldman Sachs conference. What are you anticipating?
Brad, super excited to be here on the ground. We're speaking to a slew of executives and retailers, as well as listening in on panels. We have on tap Arc'teryx CEO, Goldman Sachs Vice President Brooke Roach, as well as on-running co-CEOs. And we're really looking to get a pulse of the health of the U.S. consumer. We want to know where exactly consumers are shopping right now as these retailers really battle for market share as consumers look for value, as well as the impact of food inflation moderating on consumers' wallets. And we're also interesting how pricing and promotion will play into the end of 2024 and early 2025.
All right, from skiing and snowboarding in the clouds to the on-cloud running platform there. You got it all covered. Brooke, thanks so much. Appreciate it. Guys, coming up, trending tickers. We're going to dig into the movements of Zscaler, Asana, and Apple. That's all coming up after the break. Time now for a look at our trending tickers on the Yahoo Finance platform. Let's start things off with ticker symbol ZS, Zscaler. It's down around 17% this morning after the cloud security company offered disappointing profit guidance for the upcoming fiscal year. Shares are reacting, as we mentioned here. The company's revenue outlook, though, that's topped the consensus. And then additionally here, as they're looking for and anticipating this range of $604 million to $606 million in revenue, that is essentially above what was the prior $603 million that was looked for by analysts out there.
Yeah, it's interesting, Brad, because this is a stock that's already been under pressure. It's down about 9% year to date, though over the past year it's up about 18%. An analyst over at Barclays saying it's had a very oddly shaped year, but they are looking ahead to growth in the free cash flow space for the company. So hopefully experiencing less macro pressures to come for Zscaler. But I'm taking a look at shares of Asana, the software company seeing losses pre-market as its guidance fell short of expectations. Shares are down around 14%. Now, as a reminder, this is the application software company reporting that second quarter revenue that was largely in line with expectations, but the guidance, as always, was not enough to make the street happy. And this is interesting to me, Brad, because we continue to talk about some of these software plays. Kathy Wood over the last couple of days saying software is the new space when it comes to the AI rally, that these software powered AI names are going to be the ones to watch here.
Yeah, it seems like some of what we've heard from other B2B companies out there in elongated decision-making cycles for big deals is impacting some of the revenue or even profit expectations for the quarter, pushing those deals to future quarters, a direct impact on some of what the analysts' expectations are. So that can certainly be a hindrance for some of the guidance that's put forward, or at least some downward pressure, at least for this near term. But that one of the negative kind of marks on this company's report here and from the call as well. Finally here, UBS boosting its price target on Apple to $236 from $190 here. There you're taking a look at the shares. Despite this, it's still down by about 0.8%. They did keep a neutral rating on this, so not an all-out raise, but a good note, at least in their target price upgrade. They're looking specifically, and it seems, in the August revenue in the Apple App Store. That grew about 12% year over year, so uptick there from what they had seen in July, about 11% there. So that is one of the areas. However, this is the same kind of firm, UBS, that had come out and issued a note on Apple talking about this super cycle and casting a little cold water on that super cycle in their previous note. I believe that was back in July that they published that one.
And that's really interesting for each individual name in the Mag 7. We are starting to see kind of a bifurcation in performance. We know that Apple started off the year really rough, right? A slew of analyst critiques of the firm, but now over the past 6 months, they've been able to recover up about 27%, obviously under pressure over the last few days amid the broader tech sell-off that we are seeing. All of this comes ahead of that September 9th, I believe, event for Apple coming up here, the iPhone event. As a reminder, too, that typically is a sell the news event for Apple. In 12 of the last 17 iPhone release dates, they have seen a sell-off. So then perhaps the next big catalyst is going to be their next earnings print, which will come out here in October.
Our tech editor, Dan Halley, makes fun of me all the time. He says I need to upgrade my iPhone. I didn't know that I was in that dire of straits and needing to upgrade from my 12 Pro Max. I see that the new cameras are better.
When are you going to upgrade? Like, we're here.
Oh, I was going to do it in September, but they told me not to.
Right.
They said the iOS with the generative AI features that are going to allow me to do all these fancy new things might come out later in the year. So maybe I'll have to wait.
We're waiting it out. All right. Well, you're also waiting it out, folks, to get all of your markets action ahead. But stay tuned with us right here on Yahoo Finance. You're watching Morning Brief.
Just seconds away from the opening bell, take a look at the U.S. futures here this morning, down across the board as of right now. We've got even more economic data that's coming up in about 30 minutes time. Jolts, we'll get that to you. But in the meantime, let's talk about what we're seeing at the NYSE. You've got Eastman ringing the opening bell, and oh my gosh, you just had an eruption of funfetti over at the NASDAQ, where BioMarin rings the opening bell there. I hope it's not BioMarine in some fancy pronunciation that they didn't give us. But anyway, BioMarin is what we're going to go with as of right now here. Great folks on both sides here. And we've got to look at the major averages here as we begin today's trading activity. We were taking a look at the futures just a moment ago. Let's toggle on over to the major averages here as we're taking a look at the Dow first. We'll give you the components look here just to see where things open up. It seems like we are a little more green than red, or you could even say split if you want to do the counting at home. By all means, free country. NASDAQ composite, the NASDAQ 100, it's still carrying a lot of losses here on the day. A lot of that protrusion over from yesterday's trading activity. Take a look at NVIDIA here as we begin today's trading activity. That adding on another 2% in declines to what we had seen yesterday. That two-day activity is what we'll toss up here. Net down by about 11% to start off the trading month here in September as well, Maddie.
Yeah, it's interesting to see that it continues to move to the downside even after the market has opened here, particularly following that $279 billion market rout that we saw NVIDIA have yesterday. By the way, that's the total of an Adobe. It's almost the total of a Netflix. So big losses for NVIDIA. And Brad, I know you brought this up earlier. Now NVIDIA has the superlative of both the best and worst one-day performance of a US-based company. So interesting to see what additional superlatives they're going to get and if NVIDIA will continue to be the driver of movement to the downside. I'm interested in the degree of downside pressure we're seeing in Amazon and Meta today, too. It looks like just a day of risk-off sentiment when it comes to the performance of some of these Mag 7 names. But markets still opening lower here after the worst single-day rout since August, rather, for the broader market. So for more on September's swings, we're going to get to Jeffrey Kleintop. He is Charles Schwab, Chief Global Investment Strategist. Jeffrey, it's great to have you on here. So talk to me about how you are approaching the dip that we are seeing right now. Is this a buy-in opportunity for you at the moment?
Well, I think you want to watch the yen for clues on the tech trade here. I mean, going long on tech and short on the yen have been two very crowded trades in recent years, and for good reasons. The yen is the cheapest funding currency in the world, meaning you can borrow cheapest in yen, and tech's been consistently profitable. So it's not hard to imagine that a good portion of the short yen trade flow has gone into U.S. tech as a cheap source of leverage. Asset managers have borrowed nearly $1 trillion in yen to invest some of that in tech stocks. So there's still a very strong link between the dollar yen and tech stocks. And we can see that even this morning with tech continuing this sell-off and the yen higher. I don't think we're completely done with this yen carry trade unwind, even though yen contracts have shifted from net short to net long. We've still got a lot of asset managers with a lot of exposure to the yen that continue to unwind those tech stocks. I think that's going to hang over us for the remainder of the year.
Okay, and unwinding of tech stocks is good for what other sectors, Jeffrey?
Well, I think it benefits sectors that are undervalued and underowned. I'd look to sectors like financials, energy, and materials. They're attractively valued, they're underowned, and benefit from the promise of Fed rate cuts and a weakening U.S. dollar.
What does that mean for you in terms of where you are finding defensiveness amid that backdrop? And I'm curious specifically about how you're thinking about the tech sell-off that we've been seeing over the past couple of days here. Is that something that you think is going to define the market trade for the second half of the year here, or is that just a little bit of September seasonality?
Well, I think it's more than September seasonality. We're seeing this show up in the entire third quarter. You know, it was interesting. In the second quarter, the average stock in the S&P 500 was down while the overall index was up, and that's simply because of tech's leadership. The opposite is happening this quarter. What we're seeing is the average stock in the S&P 500, look at the equal weighted index, is outperforming the capitalization weighted index. So we're seeing strength outside of tech. That's been our story about the second half of this year, a broadening of the market. Again, focusing on sectors like financials that benefit from some of the trends we're seeing right now that may offer some defensiveness in the face of this lingering pressure on the tech sector.
Some continued contraction shown in the ISM manufacturing data that we saw come out yesterday, Jeff. Plus, we're going to get job openings, labor turnover survey here today, and then, of course, the all-important jobs report. This seems like a very similar setup in terms of the market reaction in early September as we saw in August. However, there's the additive of what we see in seasonality during September. How much volatility do you think that reinserts back into the equation here?
Yeah, it's certainly a risk. There are a lot of factors setting up, and we've also got the looming election, right, coming up that adds more risk as we get closer there to volatility in the markets. One thing I'd say that's different is that in early August, speculators like hedge funds were net short 190,000 yen contracts. That's near $16 billion in short yen. They were forced to close out all those trades rapidly, meaning selling off stocks like tech and buying back the yen. But now they're net long 26,000 yen contracts. There isn't the same vulnerability for a short-term shock to markets on some of this weaker data. Even if the jobs report comes in softer, the JOLTS data today, some of the other data suggests the Fed might shift towards a 50 basis point rate cut from our expectation of a 25. Don't expect the same type of reaction. Yes, I'm still worried long-term about this yen carry trade unwind, but in the very near term, the vulnerability to a shock is much lower than it was in early August.
So when we circle September 20th in our calendars here for that next Bank of Japan meeting, how big of a red mark should I put on that day to prepare for the show? How big of a potential issue is that going to be for markets that day?
Oh, it'll be a major focus of the markets for sure. I don't think that the Bank of Japan is backing away from rate hikes. I think they're going to continue to hike rates, probably the next one around the end of this year or beginning of next year. And that's on a path higher. At the same time, the Fed is on a path lower. So this is going to continue to be an issue for the markets. Also on September 20th, that's right. That is the BOJ date. That's also the date that we get the date at which the countries in Europe that are subject to the excessive deficit procedure. This is France and Italy now are being forced to constrain their budgets. They've got to have their fiscal plans filed on that same date, September 20th, and that could provide market participants with a catalyst to position for tighter fiscal outlook in both of those countries, which could actually strengthen the euro versus the dollar, in addition to the Bank of Japan meeting strengthening the yen versus the dollar. So that could be a big day for markets.
Yeah, it could be either for that week, a series of fortunate or unfortunate events as well here. As we know, September 17th and 18th, that's going to prelude what is taking place in Japan with the U.S.'s FOMC meeting as well. What is the tenor that you expect to come out of the committee members, not just for their decision that is expected at this point, and it has been essentially telegraphed to be a 25 basis point cut from what we expect, but about further cuts and that pathway going forward from here?
I think we'll hear more emphasis on the job market. We certainly got that out of Jackson Hole, and I think that is the message that the Fed wants to convey, that they are now maybe even more concerned about the job market than they are about the inflation picture, declaring a little bit of victory over inflation and focusing on jobs. So much of the tone of that meeting on the 17th will be decided by what we hear this Friday.
All right, Jeffrey Kleintop, who is Charles Schwab, Chief Global Investment Strategist. Jeff, always a pleasure to grab some time with you. Thank you.
Thanks for having me.
Certainly. Let's get a check-in on Bitcoin, continuing its decline, now dropping below 57,000. And this has been what's a historically tough month for the digital currency here. There you're taking a look at Bitcoin, BTC USD, which of course the markets for crypto never close, but as of right now, over the past 24 hours, you're seeing it lower by about 3.7%. And this could have some broader ramifications as well for mining operations as profitability really comes into focus, as they're making sure that the hash rates make sense for how much they're able to pull out from their own kind of just rapid solving of equations. That's what it comes down to. You're just solving a bunch of problems that a computer spits out to you. So anyway, at the end of the day, that is something that's more so in focus as you see some of these drops for some of the publicly traded miners here as well.
Yeah, I love that you always focus on the miners, Brad, because it's certainly a way that a lot of folks in our audience own the Bitcoin trade outside of just this asset. But just in terms of Bitcoin itself, flirting with a 1-month low yesterday, down about 4% at one point in the trading day. If it hits that key 50,000 level, it's hovering around the 55,000 level right now, but that could be another key technical level for Bitcoin, which could see even more pressure on the asset moving forward here. Also, Bitcoin ETFs had their longest outflow since June over the past couple of days here. So it'll be interesting to see whether or not that jobs report coming up on Friday leads to a little bit more bullishness, not just for the broader markets, but also for asset classes like Bitcoin, as it seems investors in this space are holding their breath a little bit, waiting for some clarity on the macro picture at the moment here. Well, coming up, shares of GitLab are on a tear after a stellar second quarter. We're speaking with the CFO of the company next, right here on Morning Brief.
GitLab's stock is rallying today after reporting a strong beat and raise second quarter. The company lifted its full year revenue guidance after surpassing expectations across the top and bottom line during Q2. That beat aided by a major improvement in the company's adjusted operating margin here. Joining us now, we've got GitLab's CFO, Brian Robbins. Brian, great to have you here on the program with us. I mean, take us into some of the success that you saw for the quarter. What was the kind of outlier or catalyst from your perspective?
Yeah, thanks for having me on the show today. Before I get into that, I'd love to tell the viewers what GitLab does, just give a brief overview, and I'll do it from a non-technical standpoint. I've written many S1s in my life, and if you do it with Microsoft Word, most of the time you're playing air traffic controller. With GitLab, it's like Google Docs. You have the system of record of everything, and all the changes and tracks are done, and so you're able to do things much faster and produce things quicker. And so first quarter results was really driven by, we've seen the demand environment be more stable. We delivered 31% year-over-year revenue growth, and we did that with an impressive non-GAAP gross margin of 91%. And so we're seeing strength really in the enterprise, in our ultimate product, which is GitLab's highest priced product, which really combines security and compliance. So I'm really happy with the results that we delivered this quarter.
What are you seeing specifically from customers looking for some of these enterprise-grade capabilities from your platform? What is the demand profile and kind of this spend propensity that you're seeing? Because, I mean, a lot of other B2B companies are talking about how there's elongated deal cycles or more scrutiny. What are you seeing from your seat?
Yeah, I think the spending environment overall remains cautious, and we've seen that, but we've adjusted our go-to-market and our sales enablement to overcome that. The great thing about GitLab is we're really easy to implement, and so the time to value and business outcome is really quick. We did a Forrester total a return on investment study, and it's over 400%. It increased about 60 basis points from the last time we did it. And payback period for our ultimate product is less than 6 months.
So I want to switch gears a little bit here to ask specifically about the seat-based pricing strategy that you all have, which, just to familiarize folks, it means that you are charged based on the number of users who have access to the product or the service here. I'm curious about your thinking on that from the CFO's seat at the company. Sorry about that. How are you planning to adapt the seat-based pricing model in a world driven by AI, where there might be fewer users actually on the back end of the product? Could that weigh on your profit margins moving forward?
Yeah, let me touch on that and how I think about it in two different ways. So first, a seat-based model is much easier to buy than a consumption-based model. When you have a consumption-based model, you're worried about how much you're going to consume and how difficult it is to budget. So with the seat-based model, you know exactly what to budget and how many seats you're going to buy. And so this is a large market. It's about a $40 billion TAM. Us and our closest competitor combined is less than 5% of the total market. And so we wanted to make the ease of buying the product and really allow our customers to recognize the positive business outcomes. From an AI perspective, we're a big believer that AI creates more complexity in the software development process. And the more complexity and more software that's developed, a platform such as GitLab will be required to create software with security, compliance, privacy, IP protection, and so forth. And so we feel like we're really well positioned with AI. We talked about on our earnings call, some key customer wins, Barclays, F5, KeyBank. And so we're happy with the AI products, GitLab Duo, that we've launched, and how that's starting to take off in the marketplace.
Brian, just to follow on that, though, we've heard over this course of the earnings season from a lot of CFOs, top brass at companies like yourself, about what this macroeconomic environment, especially on the employment front, could mean for a seat-based model here. How are you modeling that into your own financial performance in the coming quarters if we were to see a pullback either in hiring or a reduction or restructuring in headcount?
Yeah, absolutely. Great question. And we saw that take place really over a year ago. And so, over the course of the last year, I've been talking a lot about contraction, which is really seat rationalization. And procurement departments have just been buying differently than the way they've historically purchased. And so pre-pandemic, or about a year and a half, 2 years ago, procurement departments would try to buy as much as they could for future hiring, future projects. They would want to do a multi-year deal, try to get the biggest discount, maybe a ramp deal, and talk to you every 18 to 24 months. What we're seeing now is in a more cautious spending environment, procurement departments are buying what's needed more on a quarterly basis and coming back to you on a much more regular frequency. And so we have actually seen that, over the course of the last year and a half, 2 years, and that is baked into our model.
All right. Thank you so much, Brian. We're going to have to leave it there, but really appreciate you joining us today. That was Brian Robbins. He is over at GitLab as their CFO. A bright spot in the retail space here, Dick's Sporting Goods raising its 2024 outlook with net sales and adjusted EPS looking better than analysts had projected amid strong demand for sporting goods. Now, this comes as the retailer bucks the broader consumer pullback trend. Still, shares not responding too positively here to the beat and raise. So joining us now to discuss, we've got John Kernan, TD Cowen Managing Director of Retail and Consumer Brands. It's great to speak with you here. So I'm just taking a look at your note, John, and you talk about this idea that we are in a struggling kind of macro backdrop for the industry. What is Dick's doing that is allowing them to buck that trend?
They're outperforming peers pretty significantly, both on a sales basis and gross margin basis. Specifically, they're getting better allocations from the top vendors, and their store experience far exceeds their competitors. So that's where they're winning, on experience, product, and engagement with the consumer.
I mean, who didn't love the store experience growing up with Dick's? I mean, you get in there, you run around the track a couple times, you test out the shoes here. What's changing so fundamentally here for a company that you said just won back to school season?
Yeah, they were a winner in back to school, for sure. Their same store sales up nearly 5% in Q2 were well above the sporting goods category sales that we saw throughout the quarter, based on some industry sources. So they're a big share gainer. In terms of why they're gaining share, the product allocations from key vendors have gotten so much better. The vendors have recognized that the consumer values Dick's, they can value the shopping experience in Dick's, and management's doing a tremendous job in merchandising and supply chain to flow through very high full price sales. So the store experience has gotten better since we were kids. It will continue to. They've got 20 new House of Sport stores opened by the end of this year, and we think that's a incremental growth avenue for them that'll generate very high returns.
How are some of the brands that weren't necessarily around when we were kids, John, like On, for example, and Deckers with the Hoka shoes, how are they fueling any of the action that we might be seeing in Dick's balance sheet right now?
Yeah, it's definitely driving traffic and conversion in store, particularly in footwear. And footwear has been a big driver of their same store sales the last, say, year and a half. For instance, in 2023, the footwear category itself drove about 2/3 of Dick's total same store sales gains. So On and Hoka are playing a big role in that. Nike, Dick's is one of the few areas they're growing in the U.S. That Nike's Dick's business was up 10% last year over year. So footwear and footwear allocations from key vendors have really improved here. Hoka and On have been big contributors to that.
Is there one sport that's putting the team on its back right now, John, when you think about the success and the growth that you've seen and expect and anticipate to continue to be the case at Dick's?
Yeah, the Olympics were a great moment. That came and went. I think Dick's continues to engage with athletes, male and female, across a lot of different age groups, income demographics, and they're winning in a lot of different sports. It's not just one sport. Dick's has become synonymous with sport, the changing seasons of sport, and the younger consumer, I think, is really taken to Dick's store experience and allocations.
It's just so fascinating to me that you keep saying store experience, and I keep thinking that I have never once walked into a store. Like, I just don't do that anymore. John, what is the advice that Dick's should be giving to other retailers in the space that are still struggling with foot traffic?
Now, Dick's has invested heavily in their store base. They're spending $800 million a year this year on CapEx. It's almost double what they were spending several years ago. Now they're using a lot of that to build out their new stores, their next gen stores, what they're going to call field house stores, and their House of Sport stores, their largest expression of sport. And that's driving better engagement with consumers. The vendors want in on square footage in those stores, and the landlords want Dick's in their top locations. So store experience matters, omni-channel execution matters, and Dick's is winning in those regards.
A Dick's Fieldhouse, my goodness, I can't even imagine that. I can't wait to see as well how that plays out for the company. It's really easy to just go spend hours in Golf Galaxy, I suppose, especially as you're trying to figure out what's right for you. But ultimately, we'll see how this all fares for Dick's. John Kernan, thanks so much for taking the time here with us this morning. Certainly. TD Cowen, Managing Director for Retail and Consumer Brands. We'll talk to you later. Also, everyone, coming up, the 3 semiconductors you need to keep on your radar this morning. That's next. Welcome back. We're taking a closer look at Yahoo Finance's trending tickers here. 3 semis to watch in 30 seconds or less. ASML, Supermicro, and AMD. Start the clock. All right, first up, ASML shares are under pressure after UBS downgraded the stock to neutral from buy. The analyst also slashed its price target over rising concerns for future growth here. There you're taking a look at shares. They're down right now by a little more than 3%. One of the key quotes from the UBS analysts, which also includes Francois Xavier Bouvignies, he said that investors will likely be less willing to pay the premium multiple that ASML has commanded over the last few years, even though it's one of the best fundamental stories in the European tech sector.
Great pronunciation in 30 seconds there, Brad. Appreciate it. Okay, we are also watching shares of Supermicro. The stock is under pressure, down about 3% after Barclays downgraded the stock to equal weight from overweight. This is a huge move from Barclays. They say that there's room for improvement for Supermicro's longer-term AI prospects. But guys, putting this in perspective, this was a price target cut of 37%. 7%. That is a massive price target cut, down to $438 from $693 based on the valuation at 12x estimated full year 2025 EPS. So just another headwind and a really rough week here for SMCI, Brad.
Yeah, big time. And meanwhile, shares are in the green for AMD. The stock right now, it's up by about 2.6%. This after appointing a former NVIDIA executive, Keith Stryer, as its new senior VP of global AI markets. Now, we know how much these companies, especially in the chip space, are really banking on demand from AI and generative AI for chips. But this adding in, of course, a key name in the operation at NVIDIA that has really been the poster child for the AI trade into its ranks at the same time where today you could see some fireworks from AMD later on. Dr. Lisa Su, Chair and Chief Executive Officer, is going to be speaking at the Goldman Sachs Communicopia and Technology Conference here. So we'll see what this company looks like going into the close and what shares are trading like.
Yeah, absolutely. And we will be bringing you some conversations with folks like Lisa as we head to that event here. But coming up, we are getting a fresh read on the labor market with job openings and labor turnover data. It's going to cross right at the top of the 10 a.m. hour. So we'll dive into that and break that news for you next on Catalysts.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Catalyst, everyone. I'm Brad Smith alongside Madison Mills. We are 30 minutes into today's trading activity here, and we're watching three big catalysts impacting markets today. July job openings data, slipping oil prices, and the DOJ's reported antitrust probe into NVIDIA.
Let's start on stocks mixed as July job openings coming in below expectations, the lowest number since January of 2021 here, showing that the labor market could be weakening ahead of Friday's big jobs report. Could a softer than expected labor market push the Fed toward a 50 basis point cut in that upcoming September meeting? We'll discuss.
And oil prices slipping once again today after hitting their lowest level of 2024 on Tuesday. OPEC Plus is reportedly considering delaying a planned output increase in October, according to Reuters. I spoke to Mark Nelson, who's Chevron's vice chairman, about the catalyst behind the lows that we're seeing in crude oil. Here's what he had to say.
Well, from a macro standpoint, I think you see two things. I think you see demand coming back to traditional growth levels. And then you see uncertainty in the market. You see OPEC and OPEC Plus to some degree controlling supply and questions about geopolitics.
And you can catch my full interview with Mark Nelson on Friday, and we'll be keeping track of those moves in the oil market throughout today's show.
And let's get to NVIDIA. Those shares continuing to fall, dragging down the broader chip sector after the Department of Justice reportedly sent the chip company subpoenas. That's part of an antitrust probe, and according to reporting from Bloomberg. How much could investors potentially be worried about regulatory scrutiny moving forward? We're going to talk to a former Assistant Attorney General about that later in the hour. But first, let's get to that breaking July JOLTS data. 7.67 million job openings. Economists were expecting 8.1 million openings. It's interesting. We're seeing a little bit of recovery here in the S&P 500. The NASDAQ still under pressure here. Job openings falling by nearly 250,000 in July from the prior month. Again, as I mentioned, this is the lowest level since January of 2021 here. Also seeing a little bit of an uptick in firings and layoffs to 1.7. That is up from just under 1.7 in July of last year. So seeing just a bit of an uptick here in layoffs and discharges, Brad, coming in at 1.1% in July versus 1% in June. I think the big question is this softness in the labor market that we are starting to see here soft enough to push the Fed for a 50 basis point cut come September, and what that will potentially look like moving forward into that jobs report on Friday.
Yeah, it's a definite on 25, maybe on 50 at this juncture, and that's what markets are trying to get ahead of as of right now. And I say definite with a bit of gesture to it, but at the same time, it's essentially what Fed Chair Jerome Powell has telegraphed because of that Jackson Hole meeting and the tenor that we heard come from the Fed chair himself. And so now, to your point, it squarely looks out to, okay, beyond September, what does that pathway of rate cuts look like? And I'm looking at the CME Fed Watch probability of where we could be come the end of December, or at least after that December meeting here. And the highest probability right now for the target rate, or where we could be eventually by that point, there's a 43% chance here, or probability that we could be in this range of 4.25 to 4.5. Now, what would need to take place from this point right now? I remind you that the current target rate right now, we're at 5.25 to 5.5. So there would need to be at least one of those 50 basis point cuts that take place between now and then as well, if there's enough deterioration in what the Fed is continuing to track and prioritize in the employment situation right now, too.
And that's why bad news is starting to really be bad news, right? Bad news for the labor market is bad news for markets right now as well. So it's interesting. We're going to continue, of course, to monitor that, Brad.
That's right. Yeah, we're going to take a deeper dive into the market's reaction to this job openings data. We've got Mike Reynolds. He is the Vice President of Investment Strategy over at Glenmead. Mike, great to have you here with us this morning. Let's just get your reaction here to what you're seeing in JOLTS. And even though it is one of the more lagging indicators, especially in the economic data that's coming out over the course of this week in the employment market here, what are you kind of taking away from this broader trend that's starting to get locked in?
Yeah, thanks for having me on this morning. There's this ongoing debate right now whether what we're seeing in the labor market is signs of deterioration or normalization. We have to remember we're coming off of one of the most tight labor markets we've seen in the post-COVID era, where there were a lot of dislocations. Businesses had a hard time finding employees. If you look at a time series of job openings now, we're looking pretty close to where we were pre-pandemic. We're coming out on the side here that this is more like normalization. We're really not seeing the bottom fall out of the labor market yet. We've looked at things like jobless claims, which are continuing to hold in pretty nicely and have actually refuted some of the more pessimistic takeaways from the SOM rule tripping last month. So we're looking at this as just another sign of normalization, but you sort of have to look at this critically as well, that you don't want normalization to turn into deterioration where you're getting into this self-propelled feedback loop where the labor market starts to just get worse and worse. So we're watching it pretty closely, but for now, things on the whole still look relatively healthy.
Mike, what are you going to look at to indicate that we are not slowing but slow for this labor market, particularly when you look at a data point like the JOLTS numbers we got today? There's a lot of individual data points under the hood that you can pull out, right? Layoffs, firings, the quit rate, separations, for example. Under the hood, what data point will you look at to determine the path forward for this labor market?
It's really important to stay focused on the leading indicators. From our perspective, one of the best leading indicators is initial jobless claims. We get it every week, and it tends to be a decent sign of where the labor market is heading, not necessarily where it sits currently. And we're still getting sort of mid 200K prints, which is really healthy in an ongoing expansion. We would start to get worried if we start to see that move up around the 300 range or perhaps even higher, as again, that tends to lead unemployment rate, and it tends to lead more general indicators of where the employment situation is heading.
Early August economic data sent the markets tumbling. Early September economic data that we're getting out, we saw a massive slippage yesterday. Here today, it looks like markets are trying to rebound here a little bit. What is your estimation of how much the early September economic data will insert even more volatility on top of the seasonality that we come to expect at this juncture, known as the September effect?
Yeah, to start this month, we've seen sort of two flavors of disappointment. You got it from the manufacturing PMIs, where the headline actually looked okay, but the internals, looking at new orders going down, inventories going up, starting to sort of give a little bit of pause on the health of the manufacturing side of the economy. There is some concern there that that's a data point the Fed might not actually react to, especially since the employment portion of the PMI was actually one of the bright spots. And the Fed's really focused on employment right now. Another side of that disappointment coin has been the AI trade. And we saw NVIDIA, one of the larger decliners and contributors to that downturn yesterday. And this is really just lining up with the classic disappointment around hype cycles. We've seen it around the tech bubble where valuations get lofty, try to sort of price in some really lofty earnings expectations going forward, and ultimately a disappointment in that. And we think we're starting to see maybe some of the initial stages of that. So it's a little bit of disappointment on both fronts, but from our perspective, not strong enough to break the camel's back here on this ongoing expansion.
I want to talk about positioning because we are continuing to see the market selling off about an hour into the trading day here off of that JOLTS data, only kind of furthering this idea of too much weakness in the labor market. Mike, what are you telling clients who are calling you stressed out about the macro backdrop right now in terms of positioning?
Sure. We have a neutral position right now in our portfolios, recognizing we're in a late stage expansion. We think the risks are actually relatively balanced here, but are concerned with some of the valuations we're seeing on particularly the large cap growth side. And when it comes to positioning, we're watching sentiment very closely. You really want to be on your toes for when the bottom starts to fall out and you get full capitulation, but we're nowhere close to that. We've started the month down a little bit, but we're continuing to monitor the sentiment really closely because you can actually get some decent opportunities there if you can identify when you're getting panic selling, but the economy is actually holding up reasonably well. Those are decently attractive entry points into markets. We don't think we're there yet, but we're going to monitor for that really closely over the next few weeks.
All right, fascinating stuff there. Mike Reynolds, who is the Glenmead VP of Investment Strategy. Thanks so much for taking the time here with us today.
Take care.
Certainly. Let's take a look at some market headlines a little over 30 minutes into the trading day, sponsored by Tasty Trade. we're seeing stocks right now for the U.S. major averages mixed, and it is off the back of that July job openings report, the JOLT survey, as you know. And we're taking a look at the NASDAQ here, still in the red right now, down by about 0.1%. The Dow, though, is positive. It's flipped positive. It's up right now by about 0.3%. The S&P 500 flat, just barely to the upside as of right now, Maddie.
Yeah, let's also take a look at some of the biggest movers this morning here. I want to take a look at NVIDIA, which was the biggest laggard in the broader space yesterday. But for now, I'm actually going to take a look over, at NVIDIA recovering a little bit here. It is moving to the upside following that sell-off that we saw yesterday to the tune of over 9%. I do want to flip the board back over to yields, though, because they are tumbling on the heels of job openings, falling to that 3-year low. You can see across your screen here that we are looking at yields that are moving as much as 7 basis points lower on the day. Ahead of the print, though, now down a little bit further. You can see that pressure across your yield curve here, Brad, with the 5-year, 10-year, and 30-year under pressure this morning. Well, on the other side of this break, a former member of the Department of Justice's Antitrust Division weighing in on NVIDIA's investigation. We're going to have all of your markets action ahead. Stay tuned for more.
NVIDIA's antitrust pressure is escalating. According to Bloomberg, the AI heavyweight has received several subpoenas from the Department of Justice as part of an ongoing investigation into NVIDIA's dominance in the AI space. With us to discuss, we've got Bill Bayer, who is the former Assistant Attorney General of the DOJ's Antitrust Division and current visiting fellow at the Brookings Institution. Great to have you here with us today. So from what you've read through here on NVIDIA and the subpoena that's come forward, does it have weight? Does it carry weight into what the allegations are and how NVIDIA has essentially kind of entrenched itself or given itself a moat in an ever-changing AI landscape that really derives from some of the chips at the bottom end where NVIDIA deals and dabbles?
Well, thanks for having me back. It's good to be with the two of you again. We don't know a lot about what the Justice Department is doing here. We understand there have been subpoenas that have come out. We understand there's some concern that NVIDIA may be trying to force purchasers of its processors, AI processors, chips, to be exclusive, let NVIDIA be its exclusive supplier, and charging higher prices for those customers who are sourcing chips from multiple companies. That could be an antitrust problem. But it's really important to note the subpoena is an early stage event in an antitrust inquiry. There's going to be a lot of time for the government and NVIDIA to negotiate what's going to be complied, both in terms of documents and data. A lot of time for the Justice Department to analyze it. And then if they want to keep going, they're going to subpoena deposition testimony from company officials, from competitors, from customers who may feel aggrieved. So we've got a long way to go. This is not a matter of weeks, it's months.
Well, and it's interesting because we spoke with Patrick Moorhead earlier about the potential timeline. He's an analyst who looks at some of the chip stocks. Let's take a listen to what he had to say about the path forward here.
I think investors know, particularly institutional investors, that any type of Department of Justice ruling, I mean, my gosh, this takes a decade. What NVIDIA can be doing is to continue to have the highest performance computing in the data center to solve the problems of the hyperscalers and the enterprises and the tier 2 CSPs.
In your experience, Bill, does a probe like this, which according to Patrick could take up to a decade, prevent companies from exploring any future growth opportunities? And could that potentially weigh on a company like NVIDIA moving forward? Or will this sort of be business as usual with the DOJ and NVIDIA?
I think most companies would continue to pursue the practices they think that are profit maximizing. I do think it's a bit of hyperbole to suggest it's going to take a decade. At the same time, one of the things the Federal Trade Commission and the Antitrust Division are trying to do is get ahead of the curve, figure out where a market may be trending toward a monopoly, and intervene earlier. They're certainly trying to do that in the AI space.
And so for the Department of Justice and other regulatory bodies that are trying to both at the same time wrap their heads around a new technology wave that they're seeing and then understand how to apply any type of the legal constructs that already exist here, you know, how much of a learning curve do you think there's still going to be around such an innovative part of the broader tech sector right now?
Well, I think the government's gotten pretty sophisticated about antitrust analysis of the tech sector. Look at the Google case, Google search engine case, which DOJ recently won. We're about to have a trial on Google ad tech. So the government has gotten more knowledgeable, more sophisticated, and I think moving more quickly than maybe 15 or 20 years ago.
I want to switch gears a little bit and talk about U.S. Steel briefly before we let you go. We know, for example, that the company and the CEO spoke with the Wall Street Journal this morning, saying that if the deal with Nippon fails, U.S. Steel could be in danger of having to close plants. That would, of course, potentially involve layoffs. I'm just curious what this indicates to you moving forward about the potential of the U.S. government blocking any of these foreign deal-making opportunities from happening. How likely is that, in your point of view, moving forward, and what are the potential ramifications of that?
Well, it's too early to tell. This is an inquiry that has been going on. It's done non-publicly, and trying to assess through this mechanism, this committee called CFIUS, the Committee on Foreign Investment in the United States, is taking a look at the national security, the economic ramifications of Nippon buying U.S. Steel. And I'm sure they're looking at the ramifications if Nippon is not allowed to buy U.S. steel. This is a healthy process. It runs in parallel with antitrust review. If it's not Nippon, who else is out there that potentially would be a suitable buyer for U.S. steel? So we've got a long way to go on this, and I realize it's very important to the workers and to the companies and to the potential Japanese investor.
All right, Bill Baer, thank you so much for joining us and really appreciate your insights on all things DOJ and NVIDIA here. Thanks so much. That was Bill Baer of the Brookings Institution. Staying with NVIDIA and broadening out to the broader chip sector, Tuesday's market sell-off wiping $300 billion from NVIDIA's market cap. The semiconductor sector as a whole was down, including Broadcom, which will report its earnings on Thursday. Are these signs of broader plateauing in the tech sector? And which companies could be vulnerable to a wider broadening of the market? For more on this, let's bring in Paul Meeks, Harvest Portfolio Management CIO and a Wall Street Beats partner. Paul, it's great to speak with you. Listen, I mean, my main question for tech investors, should they hold through this or should they be worried?
Bottom line there is they should hold through this. And actually, when we get the next signs of a trough in some of these stocks, I think you should probably buy them and a couple of my select names aggressively.
What are those signs to the trough? What are the keys to that you would be tracking?
Yeah, so right now, because I believe so strongly in the fundamentals of companies like NVIDIA, then a select others in the semiconductor food chain, remember we had a pretty nasty spill in these stocks only about a month ago. So I want to see a retest specifically for NVIDIA of a break below $100 a share, because the last time that happened, the stock found some support and very quickly bounced back to 130, so it was threading a all-time high. So I'd like to see a successful retest of those lows that were set just a month ago.
What is it going to take for a successful retest of that to happen, Paul? What's going to be the next big catalyst for that action?
Well, the next big catalyst is technicals. I mean, I feel strongly in the fundamentals. The only thing that's changed today, and you had the prior guest, is the subpoena that the Department of Justice has sent to NVIDIA. I mean, that's obviously an incremental negative, but I don't think it's that big of a deal at the end of the day. And I don't think it's going to be resolved for months, if not years. So I think it's technical. And technical is just when we see the stock trough, I think it's going to test that sub $100 price. Maybe we see the trading volume dry up a little bit. So it looks like we have an exhaustion of selling, because right now I'm spending more time as a technical analyst than a fundamental analyst. Not my choice, but that's where the market's driving me.
Paul, with that in mind, what are some of the most vulnerable tech stocks to broadening out in this market?
I think the ones that are particularly expensive, but I wouldn't put NVIDIA in that camp, because believe it or not, NVIDIA today is only trading at 29 times next year's earnings. It's not that many notches above the S&P 500 for a lot better growth. So some of the, I call them AI pretenders, companies that talk about AI apps that won't really become mainstream for way too long. I worry about those. But the AI infrastructure builders, which are primarily the GPU vendors and also the data server vendors, and also maybe a couple of data networking vendors, I think will continue to do quite well and should be the focus area within the tech sector.
So what are you doing on a week like this, Paul?
I'm about ready to shoot myself. No,
Paul.
I say that in jest. So what I'm doing is I'm just following the charts. Not really my bag. I'm a fundamental analyst, but I just need to see stabilization, because I've made my fundamental choice. And my fundamental choice is to add to positions like NVIDIA and Micron. But there's geopolitical factors. There's anxiety about the rates move on September 18th. But I think I listened to the same conference call that everybody listened to just a couple of days ago for NVIDIA. Some people came out incrementally bearish. I did not. Some people lowered their estimates in the last few days. I did not. And I still think that there's a great upside. And the reason I talk about this so much is it is still, even at this valuation, I think the cleanest name in tech.
Paul, when you think about what's been well documented over different cycles of rate cuts, technology has been one of the beneficiaries of easy money policies. Do you expect that to be the same this time around, as largely anticipated the Fed is going to begin cutting interest rates in September here?
Well, you raised a great question because it's a two-sided coin. One is, yes, as rates go down, the discount rate to value aggressive growth in other tech stocks brings much higher valuations. That's the positive. On the other side of the coin is the reason that the Fed is lowering rates is now they've gone from being concerned about inflation to being concerned about a recession. And no matter what tech companies say, they are somewhat positively correlated to the moves in the economy. So I see it both ways. But over time, that and on the other side of the positive ledger, the AI boost makes me still want to stick in here.
Paul Meeks, Harvest Portfolio Management CIO and a Wall Street Beats partner. Thanks so much, Paul. Good to see you.
Thank you.
Let's check in on another trending ticker here. Qualcomm getting a boost after launching its latest PC processor. Today's move is the latest effort by Qualcomm to challenge Intel's dominance in the PC market. Qualcomm has historically focused on smartphone processors, but has ramped up efforts in the PC space as of late, and looking to capitalize on a growing desire from customers to incorporate AI into devices. You're taking a look at the move here on the day. It's up by about 1.4%. One of the announcements is the expansion of what is the Snapdragon X series portfolio, this addition of the Snapdragon X Plus 8 core. Why does it matter here? This platform basically brings better battery life, better performance, Copilot Plus features for all you AI fans out there. Plus, they're looking at lower price points for consumers here as well. And we know how much this is important for Qualcomm to be able to sell into some of their existing portfolio client base. And so this is going to be one of the things that investors are tracking here, and it's certainly having an impact on today's market action and price action.
Yeah, it's certainly seen a recovery in the stock, though we still have not seen the stock hitting back to where it was prior to those NVIDIA earnings that led to pressure across the major tech names, particularly in the chip sector. Over the last 5 days, you've got Qualcomm down about 5%, but over the last month, we are seeing a little bit more recovery when you zoom out a little bit on a stock like this. So I think it is an indication of sort of what Paul was saying, this idea that you're sort of looking at the technicals more than the fundamentals when it comes to a lot of these chips names, because even fundamental news about individual companies like this coming from Qualcomm, not necessarily enough to bring the stock back to recovery mode based on the downward pressure that we've seen across some of these chip names. All right, well, Airbnb moving here pretty much flat, though, after Argus Research cut its rating to hold from buy. The analyst citing slowing room nights growth and warning that soft demand and increased competition could continue to be headwinds. And this is interesting because this also follows the news that we talked about yesterday with regards to Airbnb fighting back against New York City's short-term renting regulations. But this note focuses on something just a little bit different, focusing on those fewer extended visits. And this is something that Airbnb was really banking on, particularly as we were coming out of the pandemic, this idea that people would be, going to Barcelona for a month and renting out an Airbnb because they could work from anywhere. As working from anywhere has certainly slowed, and Brad and I know that all too well, this has put some pressure on the likes of Airbnb here.
It's really interesting, and what we heard from the company last quarter for Airbnb, and it comes back to something that you were just mentioning here, a shrinking of lead time. So a little bit more pensiveness in the system from customers right now who are booking those trips. They saw growth, but in last minute trips. So softness in those long lead trips is what that directly equates to as well. There's an interesting J.D. Power survey that was out, or at least study that was out this morning, and I'm gonna bring this full circle here because Airbnb is one of those companies that even as they're dealing with consumers who in the accommodation space tend to, in times of an economic downturn or in more of the discretionary dollars really being scrutinized that are going out the door at a household level, they lean into loyalty programs. That is something that Airbnb has really had to wrap its mind around, as some of its competitors in the traditional trad hotel, if you want to call it that, they have really leaned into at this juncture in time. And one of the secrets to a great branded hotel stay, maybe in the aspect that guests don't often realize, third-party management companies operating the hotel, creating consistent, pleasurable, problem-free guest experiences there. And that is something that Airbnb has had to really wrap its minds around, and its operations around how you continue to replicate that experience, especially knowing that you are not operating the particular stay itself. It's so many of the other people that are on the platform that are listing their stays that you have to make sure that there is a consistent experience across. And so that really coming through in this JD Power survey, and there's third-party management companies operating some branded hotels, firing on all cylinders, they have said. So that's the kind of lay of the land in the environment right now that is really being navigated through in the accommodation space.
Really great point, though. It's hard to have quality control when you're dealing with hosts across the world, right?
A lot of attentiveness required, yeah.
A lot of attentiveness. All right, well, coming up, retailers Dick's Sporting Goods and Dollar Tree moving to the downside here after earnings. We're going to discuss what results from these retailers tell us about the health of the consumer. That's next.
Investors this morning getting a checkup on the state of the consumer from a round of retail earnings. Dick's Sporting Goods raised its earnings forecast, though not as much as the street was hoping, while Dollar Tree, they slashed their sales forecast, citing a challenging macro environment. Joining us now, we've got Jerome Martis, who is the LSEG Director of Consumer Research. Great to have you here on set with us. So as we're parsing through even more retail earnings, I mean, really kicked off last week, the week prior at the tail end, what are you kind of gathering about where the consumer is leaning into to try and offset inflation to the best ability here?
Well, it's good to be here, Brad. The consumer is definitely very value-oriented, and that's the most critical thing for them. And it's not just the low-end consumer, what we saw with today's numbers, also the middle-class consumer. They're thinking twice about any expenditures over $1,000, and even thinking twice about now opening up more credit or financing anything that's a big purchase as well. We're also seeing that omnichannel is very key for them. The consumer is all about instant gratification, and today Dick's Sporting Goods also beat on the premises that part of their strategy was to have a very good, strong omni-channel presence, which is in line with what we've seen with the other retailers as well.
Help me understand this, because I'm hearing you say consumers are looking for value, and we can see that in the likes of, say, a Walmart earnings, for example, right? But then you look at Dollar Tree, Dollar General, but let's focus on Dollar Tree for today. what am I misunderstanding? Why is that not a beneficiary of some of these macro headwinds?
Right. So that particular consumer, their core consumer that makes less than $35,000 a year, is definitely being financially constrained the most. On top of that, the dollar store in itself has some store-specific issues and inventory. But it's very important to note that a lot of the dollar stores, both Dollar Tree, Family Dollar, Dollar General, have all lost market share also to the big box retailers like Walmart. So in the past, it used to be that consumers used to go into a Walmart and they only stuck to those groceries, primarily groceries. But now, since the pandemic, Walmart has gained more customers. They've increased their selection to those everyday low prices items. So as a result, these new customers that are coming now to Walmart are not just only buying groceries, but then they're also picking up these discretionary items, and therefore the dollar stores are losing those market shares.
Which company is best positioned to really navigate through this consumer value hacking environment that we've seen really play out right now?
That would be the big box retailers like Walmart, Target, TJX, and again, that's because of the value proposition. Old Navy was a big winner for back to school because those parents know those kids are going to grow and those items are only going to last a few months, so why spend more money, right? So all those companies that have the value propositions are the ones that are the big winners.
It seems like value proposition right now, another word for that, at least from the consumer perspective, is who's giving me them discounts? Yes. Where are the biggest promotions taking place? But those promotions can also be profit pressures for retailers right now, too. How are they navigating and communicating to the street how much those promotional efforts are really going to be a near-term headwind for financial performance?
So if you recall, during the second quarter, the monthly U.S. retail sales was the strongest during the month of July. And this was primarily driven by Amazon Prime Day, and then all the other retailers piggyback on that event. So this is telling us that, and retailers are telling us that they're only opening up their wallets if they see a discount or promotion. In a collaboration with Centric Market Intelligence, we found out that the most amount of merchandise was on sale in July, which is why the consumers went out and shopping. However, what has not changed is the average discount. So to your point, that average discount percentage is still below that 40% mark. So it's more of an illusion. Consumers are just seeing that more merchandise is on sale, but the discount offered on those products is still below 40%. It's the same discount that you will get any other time of the year.
So I've been bamboozled is what you're telling me.
You've been bamboozled, yes. So therefore, margins are not being hit as much at these retail stores. And that's the similar trend that we're going to see going into the holiday season. A lot more merchandise on sale, but the average discount less than 40. So the 40% is the secret number. Unless you're getting a 40% discount, you're really not getting a good discount.
So what does that tell us then about pricing power at these retailers? Are we starting to see, the disinflation that the Federal Reserve would love to see in actual just headline prices coming down?
I think the numbers that we saw today are a key indicator that that's not the case, or in general for the second quarter. It's telling us that the consumer is very, extremely cautious, where they're spending, whether it's the low end or both the middle class consumer. So no.
Yeah, no, it's fascinating and a really good insight into not just what's going on amongst the retailers themselves and the stocks within the retail space, but also the macro environment, Jerome. So really appreciate you joining us. Thank you so much. Again, that was Jerome Martis, LSEG Director of Consumer Research. Sticking with retail, let's get a quick check on shares of Nordstrom. They're down about 0.25% here after the department store chain confirmed it did receive a buyout bid from the Nordstrom family. Eric and Peter Nordstrom, the great-grandsons of founder John Nordstrom, formed a group with other members of the family and Mexican department store chain Liverpool to take Nordstrom private for $3.8 billion, Brad.
Yeah, under terms of the proposal, Nordstrom family members and Liverpool would pay $23 for each outstanding share that they own. Now, the bid, it comes about 5 months after Nordstrom said it formed a special committee to explore a sale, but said current shareholders are not required to take any action. We'll continue to bring you updates as they come here on ticker symbol JWN. And coming up, with potential rate cuts on the horizon, how should crypto investors be setting up their portfolios? We'll discuss when we come back.
Turning now to Bitcoin, the digital currency down over 10% in the month of August, its worst month since April. This comes as traders move to the sidelines over uncertainty about the timing and degree of Fed rate cuts come the November election as well. Here to help break down where Bitcoin and the broader crypto market could be headed, we've got Andy Baer, CoinDesk Indices Managing Director. Andy, it's great to speak with you here. So we've been talking consistently over the past couple of days here about the degree of pressure that we are seeing in Bitcoin. What is driving the degree of that pressure right now?
Yeah, it's been a long summer, right? A lot of long days with Bitcoin trying to find a base for a good uptrend. Bitcoin and other cryptocurrencies have a lot of time series effect, like they have a lot of momentum. So once they start going, they tend to keep going. But ever since the honeymoon of the ETF inflows started to die down at the end of the first quarter, things have been kind of flat, right? So lower liquidity, a little bit of weight from Bitcoin supply coming from the Mt. Gox resolution and from the US and German governments threatening to sell sort of Bitcoin that they had seized. We just keep trying to rally, and then things kind of peter out. The latest case with the NVIDIA pullback yesterday, seeped a little bit in a contagion way into the crypto market. So once again, we try to break through that 62, 63, 64,000 mark, and then we find ourselves back here. So for now, it's just keep on keeping on and just wait for the next catalyst to take us higher.
And so in the meantime here, I mean, if we see some of the same type of inputs really taking place in this month of September, which for crypto has already historically been bad as well here, what type of net effect are you anticipating for Bitcoin, and what does that mean for the appetite for risk assets, where crypto is certainly, and Bitcoin certainly is within that realm, perhaps one of the poster children?
Yeah, no, it is a risk asset. We really like to think of Bitcoin as having its own unique macro drivers, right? It likes low, forward-looking real interest rates, so nominal rates minus inflation. So in a way, Bitcoin's table setting right now is perfect, right? We have a series of rate cuts coming. I don't think anybody thinks inflation is going to crater. So you have these kind of real rates going lower, which should be a great environment for Bitcoin. But we have an election coming up, which is going to be polarizing and create volatility. So for longer term investors, we think now is a great time to kind of maintain the faith and keep going. Where it hurts the other cryptocurrency assets, the other digital assets, is that they need Bitcoin to lead. When we look back to the heights, the emotional heights and the price heights of March, all 20 tokens in our CoinDesk 20 index were in the green for the year. Now only 6 of them out of the 20 are. So really think of the other tokens, including Ethereum, as being attached to Bitcoin sort of with a rubber band. So Bitcoin starts to go higher, and these higher beta ones are going to kind of slingshot past it. So we need that to happen. We need liquidity. We need more volume. We need momentum. I think investors do want breadth, right? We have a bunch of demand for CoinDesk 20 products. Just this morning, Finst, which is a European retail platform, just announced they're going to offer bundles of CoinDesk 20. This adds to funds and SMA platforms and derivatives. So investors want breadth, they want indexing. They just need Bitcoin to lead the way higher, and then the other assets are going to follow.
I'm hearing you mention the election a little bit more than the Fed moves come September, and I'm just curious, which of those two events is going to be the bigger deal for crypto?
The election, I think, is going to be a little bit harder to predict. I think short-term moves after a rate cut, I feel and hope that we're going to get, we feel confident about 25 basis points in September. 15, I guess, is a possibility, but not a likelihood. The more that the Fed broadcasts that rate cuts are going to happen in order, the less mystery there is and the more certainty there's going to be. And I think that will create a strong foundation. The election right now, I don't know what you guys are reading. I'm reading like toss-up and a lot of noise. Part of that is how cryptocurrencies are going to be supported by the next administration. But part of that's just going to be mood and sentiment about the markets in general. So events like that with very tight probabilities, you kind of just want to leave some money on the table to take advantage of the aftermath of those things.
How much of, and for the candidate on the Republican side, former President Trump, and his own crypto account or his fund being linked to a hack, how much of that is a negative kind of overhang for what he's already touted as him being the crypto candidate in this race?
We care about the formation of steady, reliable, usable regulation, right? If I go to Europe, if I go to Asia, and I meet with regulators, they have virtual asset rules, which let you build exchanges, which lets you launch tokens. Here in the United States, it's a little bit more difficult. So I think the real industrial concern is about the state of regulation, whether that's going to be legislation or which regulators are appointed, or how the CFTC and the SEC and any kind of new regulatory organization will support the industry. It's very interesting what's happening with the Trump tokens, because it just shows that there's a lot of distribution effect. There's a need for borrowing and lending products. There's a need for identification with a candidate in a kind of a meme coin kind of way. When governance tokens are launched, or when lending and borrowing platforms actually get launched, and a lot of faithful come to use those platforms, we just have to make sure that they don't have a bad experience, because that will reflect badly on the industry. So great that it's happening. We do need more borrowing and lending in the market. I think most serious industry participants are just hoping for a more stable and usable regulatory environment in the United States.
Andy Baer, who is the CoinDesk Indices Managing Director. Andy, thanks for taking some time. A good neighbor here, at least in offices.
That's right. Go downtown.
Thanks so much. Appreciate it. Coming up, everyone, Vice President Harris will unveil her plan for new small business owners this afternoon in New Hampshire. We'll have the details when we come back. It's time now for our trending stories. Today, we're honing in on Washington, the capital. First up, Goldman Sachs says that come November, should Trump win the White House, we could see a GDP hit, while a Harris win would boost the economy due to, quote, new spending and expanded middle income tax credits that would slightly more than offset lower investment due to higher corporate tax rates. We've been continuing to get some of the election watch updates, even UBS continuing to come out with their own election watch almost weekly here. And from everything ranging from tariffs to what some of these small business or even household tax credits could mean, we're getting even more indication here from Goldman Sachs about the possibility for a blue sweep or a Democratic sweep being better for the economy than a Trump win as of right now.
Yeah, it's interesting, the Trump win being something that could lead to growth in tariffs, tighter immigration policy, that could outweigh any positive fiscal stimulus from those things. On the other side of things, VP Harris, when they talk about her potential policies, they say that new spending and expanded middle income tax credits could offset lower investment due to those higher corporate tax rates. Really quickly want to note, though, Goldman's been on this train since June before Biden even dropped out of the race. They had that note saying that Trump would fuel inflation, so it was time to buy gold. So this is only a continuation of the bank's further comments about the potential inflationary output of this upcoming election here. We're going to also keep our eyes on Vice President Harris as she is set to unveil a new small business tax exemption proposal today at a campaign event in New Hampshire. This comes ahead of her first debate next week with former President Trump. Yahoo Finance Washington correspondent Ben Werschel has the details for us. Hey, Ben.
Hey there. How are you?
Great. How are you?
Yes.
So, yeah, talk to me a little bit about what we need to know about the small business impact of these policy proposals here.
For sure, yeah. Picking up on the Goldman Sachs note, this is a spending proposal from Kamala Harris that she's going to formally unveil this afternoon. The headline here, it's all about small business, is what she's trying to focus on this week. And the headline here is a tenfold expansion of tax credits for small business. Currently, if you're starting a small business, to help you with startup costs, you can get up to about $5,000. She wants to make it $50,000. So it's a big expansion there, and this is part of an overall goal of spurring 25 million new small business applications, she says, if she wins, that she hopes to have over her first term. So this would be a big focus on small business there. And then there's a bunch of other ideas in there about red tape, occupational licenses, standard deductions for small business, a little bit more wonky, but a kind of overall plan here for small businesses. And this is part of her opportunity economy, which she's been laying out in stages. A couple of weeks ago, it was a cost of living plan, housing, grocery stores. This week is small business, and then we're expected to see more in the weeks ahead.
Juxtapose this against what we've heard from the GOP and candidate former President Trump as well, who's kind of more focusing in on where the corporate side could get certain cuts. You know, how is this really starting to shape out where both candidates are going to prioritize and win voters?
Yeah, well, what's interesting to me about the dynamic here is this seems to be a kind of a fight both sides want to have. Harris has a new ad out this week that highlights Trump's desire to lower the corporate tax rate. It's 21% now, the federal rate is. He wants to make it between 15 or 20%. Harris has talked about raising it. So they're happy to talk about that and then contrast it with these small business ideas they're saying. They're sort of setting that up as a dynamic here. And as you mentioned, Trump is focused there as well, sort of saying more broadly that Harris doesn't understand small business and that Trump's economic record proves he'd be better in the overall, but without these kind of policy proposals.
All right, Ben Werschel, thanks so much as always for joining us and giving us your reporting there. Really appreciate it. And Brad, such a great question from you just in terms of the potential impact here. It's going to be fascinating to see how this shakes up as we do head towards that upcoming debate between Harris and Trump here. Yeah, a bunch of topics that have really played out over the course of today's show that are going to be on those debate stages, however many those are. And of course, we'll hopefully get some more timing and clarity around that, whether it be small business focused initiatives, whether it be household focused initiatives for parents, and then additionally for homeowners as well here. We've heard all of this be discussed, I think more largely on how this could impact some of the publicly traded companies that we've been talking about in the first 90 minutes of trade here on the day. It comes back to what UBS, is talking about in global trade and how that's also going to be on the debate stage. Traditional view of global trade has evolved very little over the centuries. However, many voters and politicians seem to regard trade in simplistic terms. Goods are made at home from domestic materials, packed onto a ship, and sold to a foreigner. All of that is going to need to come into focus as well for that global and international strategy from both candidates here too. Absolutely. All right. Well, coming up, stick right here with us for Wealth. It's dedicated to all of your personal finance needs. Brad Smith is going to have you right here for the next hour, so stay tuned. Hey.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, tips, and tricks that you need to grow your money. Hey, on today's show, navigating a volatile markets, we're going to talk to one strategist about the best ways to play the market in September. And we'll also discuss the best ETF plays to cash in on the weight loss drug market. Stick around for that. Plus, building the wealth of your own business. I'm talking to the co-founder and CEO of Eastside Golf about the company's efforts to drive change in the game. All that and much more coming up, plus some breaking news. But first, we're taking a look at some of the market action. 90 minutes into the trading day here, stocks, they are in the green, rebounding from earlier losses at the opening cross that we saw. September is traditionally known as a challenging month for stocks, and the whipsaw market action so far this week is certainly suggesting that may be set to continue. Add in potential rate cuts and then the November election, and it can be tough to figure out exactly how you should arrange your portfolio to set you up for a successful 2025 here. So here to help with some of the tips and guidance, we've got Veronica Willis, who is the Wells Fargo Investment Institute Global Investment Strategist. Veronica, always a pleasure to grab some time with you here. Okay, so it's like we're repeating August all over again with some of the early market swings that we've seen to begin the month of September. And it's really seeming to be driven by some of the early economic data here. What most notably would you be tracking as it relates to the market volatility or the market whipsaw that we could be set to see with some of this data coming out this week?
Yeah, I think the labor market is going to be what's in focus this week. We saw earlier today with that reaction to the JOLTS job openings coming in under consensus. We've got plenty of other labor market data for the market to pay attention to this week with that jobs report on Friday. And I think the market has quickly shifted from hyper-focus on inflation to hyper-focus on the labor market. So that's really what's to watch for this week.
And what specifically would the markets be tracking within that labor market? Is it a continuance of what we'd seen within JOLTS today, where you're seeing a shrinking of some of those openings, and then additionally on the jobless claims, you see jobless claims continue to rise, or you see, for instance, on the employment situation, that unemployment rate tick up further here? What's the most important metric that the markets are really going to snack on?
I think it's going to be that payrolls and the unemployment rate on Friday's jobs report. Really looking to see if last month is a signal of what we're going to see going forward. Is that unemployment rate going to continue to tick higher, or are we seeing a bit of a normalization in the labor market? Expecting some softness there, but hopeful that we're not going to see anything too concerning with the labor market. But if we get a bad jobs report, I think that's going to be another catalyst for some market volatility.
And we've seen some rotation, especially as we do track the pullbacks in tech specifically. As we were watching that yesterday and then earlier on today, even though things have reversed a little bit, you kind of got the sense that if there was some profit taking in tech, that could lead to a broadening elsewhere. Where and which sectors seem most ripe to take in some inflows or see increased volume as a result of that broadening?
Yeah, so right now we're liking some cyclical sectors. We like communication services, industrials, materials, financials, and energy. I think those are some of the sectors that can really benefit from that pullback that we've seen in tech, because they've also got some exposure to some of those longer term trends where we're expecting some growth in the economy, particularly in AI. It's not necessarily just a tech trade, but some of these other sectors can really benefit from that.
With that in mind, and we're taking a look at some of these portfolio tips, what are your tips for investors who are trying to just navigate these next couple months here in September and October ahead of what is another major catalyst event for the markets in the November election?
Yeah, so I think right now focusing on a little bit higher quality in both the fixed income and the equity exposure. So thinking of being invested in large caps over mid and small caps. It's probably good for the near term. We're expecting those large cap companies to be a little bit more resilient through all of the economic uncertainties that we have coming up over the next few months. And then in the fixed income space, just focusing in on that investment grade over the high yield space, not taking on too much risk as we're expecting that volatility. And then eventually after, the economy has slowed down a little bit and has started to grow, into 2025, that's when you can move into some of those higher beta, riskier areas.
You know, even as we've been talking about the employment side of this, of course, in the Fed's dual mandate employment and then inflation as well. And that takes us into the mindset of the consumer. For a consumer that's looking for more discounting, more value hacks as well in their own spending and smart spending habits that we've been trying to put in front of people and bring to their attention as well here. If we do see a continued pressure on the consumer, what does that spell out for companies who might be the most vulnerable, and where could we see that play out in the equities market?
Yeah, I think in the equities market, it's going to hit that small cap space first, which is, why we favor large cap over small cap. Those tend to struggle the most when the consumer starts to cut back. Those larger cap companies tend to be a little bit more buffered from that. They tend to have a little bit more cash on the balance sheet and can account for any pullback in the consumer. And so I think that large cap space is going to be a little bit safer through an economic slowdown led by consumer spending less than some of those smaller companies.
Veronica Willis, who is the Wells Fargo Investment Institute Global Investment Strategist here. Veronica, thanks so much for taking the time here with us today.
Thank you.
Certainly. Well, September is no stranger to volatility, and the swings have already begun. After Tuesday's steep sell-off, all three major averages, they're rebounding from some earlier losses. But a busy few days of econ data ahead, including the August jobs report on Friday, that could further complicate the path forward. For more on how to position yourself for a volatile September, we've got Christian Magoon, founder and CEO of Amplify ETFs, who's joining us as part of this week's ETF report brought to you by Invesco QQQ. Christian, great to see you. Great to catch up once again. So first and foremost here, as we're tracking some of the volatility, some of the swings, as we've now crept back into positive territory, we'll see if we can hold on to that as we go on throughout some of the economic data readings the rest of this week. What are the ETF plays that investors would be apt to keep on their docket?
Yeah, hey, Brad, good to see you. Thanks for having me on. And, I think one of the areas going into September and October, this volatile period in the fall that's really accentuated during election season would be looking at your core equity position. And instead of maybe going just 100% long, looking at a high quality covered call equity strategy that would give you kind of the benefit of higher quality names, but then also the ability to have covered call income from those names, which acts as a hedge during kind of downward market environments, and also kind of benefits in terms of more option income as markets become more volatile. So I think that would be a great complement or even an alternative to a long-only equity portfolio. We have an ETF, DIVO, D-I-V-O, and it's 5-star rated and does just that, owns high-quality blue chip dividend-paying stocks. It's actively managed, and then the managers have the ability to write covered calls on the portfolio. So you're not just dependent on capital appreciation for your total return. You also get dividend income and option income. We think that's kind of a great way to have a belt and suspenders, so to speak, going into this volatile fall season.
One of the sexiest trades in the market to talk about has been this AI trade and the AI theme and all the ETFs that really surround it. But one of the other sexy trades is this weight loss drug market for both health and for any other reasons that people are tapping into some of the GLP-1s and the associated type of solutions that are being put into market here. And this is something that you're tracking. How are you playing the weight loss drug market via ETFs?
Yeah, so we launched the first ETF that tracks this GLP-1 weight loss drug category. That's the Amplify weight loss drug and treatment ETF. Ticker THNR, thinner. So it's an index-based ETF, the only index-based ETF to track this segment that owns the companies that are manufacturing GLP-1s and that are in clinical trials on the GLP-1 side. In addition, it owns some of the enablers of this technology, the companies that are making the injection pens, doing the testing or third-party manufacturing of the drugs. So, GLP-1 drugs could be the largest category of drugs ever because of the total addressable market, right? So many people think of them as just weight loss drugs, but now, Brad, they're being prescribed. People have cardiovascular issues, also for diabetes. And when you start looking at who qualifies for that, just in the US, it's close to 70% of the population. Now, these drugs have been in short supply. The supply is starting to ramp up. Insurance coverage is starting to become more robust. So we think that this is a great kind of early innings play for thematic investors, and maybe has kind of the appeal to be able to withstand some of this market volatility, because we expect to see continued good news from clinical trials and breakthroughs in this space. And by that, I mean not just injecting drugs, maybe using them in pill format, maybe only being able to take a pill once a week or once a month. And of course, other types of uses beyond kind of the big three, which includes maybe Alzheimer's, sleep apnea, and addictive behaviors. So this GLP-1 trend is a big deal. And we think our ETF, THNR Thinner, is a great way to play it from an index standpoint. Why choose one or two stocks? Instead, you can own the basket that's professionally selected.
And just lastly, while we have you here, another core theme that you're tracking is cybersecurity here. There's been a lot of movements within cyber as of late, whether that be CrowdStrike or what we've heard from some of the other entities that are really trying to make sure that even as generative AI means more data centers, more powerful data centers, that there's more cybersecurity put around that here. What's the play there?
Yeah, we really think this is a resilient theme, Brad, going into the election. I mean, there's a lot of geopolitical issues, both internally and externally. This morning, the FBI kind of announced a North Korean threat against companies, including, I guess, Amplify ETFs, companies that are involved with cryptocurrency ETFs and cryptocurrency funds, of which we have exposure there. So, these cyber attacks and criminals are becoming more sophisticated. This is an essential spend in the technology area. So our ETF, HACK, H-A-C-K, is the first cybersecurity ETF to launch. It's the original one here in the U.S., index-based. And again, it owns kind of the broad-based companies in this sector. And we think the demand for this is very inelastic. Companies, governments, individuals, we can't not spend on cybersecurity. The risks are too high. So we think this is a theme that is really worth taking a look at. For those who are technical traders and looking at the chart, if you look over the last 3 years, there is seemingly a cup and handle forming. So we could see a breakout. We're at relative highs here for cybersecurity, a little bit off, but we think a resilient theme to kind of take you through the fall and into the next year.
Christian Magoon, who is the founder and CEO of Amplify ETFs. Christian, great to catch up with you once again. Thanks so much for taking the time.
Thanks, Brad.
Certainly. Coming up, we're heading to the NASDAQ, where our very own Brian Sozzi is speaking with the CEO of Beyond Meat. Stick around, everyone. We've got much more on wealth after this break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here,
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
this is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action
With step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market domination. Tune in daily from 3 to 4 p.m. Eastern.
All right, welcome back to Yahoo Finance. I'm Brian Sozzi, executive editor here at Yahoo Finance. Really fascinating day here at the NASDAQ. Catching up with Ethan Brown, the founder and CEO of Beyond Meat. You're giving a little update on the company and where things stand. Good to see you, Ethan.
Great to see you. Thanks for having me.
I had a little bit of a flashback moment. I mean, this is the IPO day, mecca for you and the company, but I mean, it's a different company, a different time. I just had a chance to taste some of your new products in a back room over there. I mean, what is the state of Beyond Meat here at this point?
So I think we feel really good about where we are. We've been now public for over 5 years, and there was a tremendous growth in the category, then a contraction, and Beyond Meat continues to lead, and we think we're going to lead the next phase of growth for the category and for Beyond Meat.
Why is the category still under so much pressure?
Well, I think what you see is there was an enormous disruption in the sense of this is going to be something that displaces animal protein. There was a very big pushback from the animal protein market. That takes time to get through. And I think we're now beginning to near the end of that, and people are starting to see again, hey, these are really good products for my health. They're very important for the environment, and most importantly, they taste great.
Last time I talked to you was at your headquarters for our Lead This Way series, and you were telling me about campaigns against the company, campaigns against plant-based food from, I guess, the incumbent meat industry. Where do those stand now? Have those leveled off at all?
Well, I think we had the opportunity to do one of two things. We could have been stubborn and say, you know what, we're just going to keep saying the same thing. Or we could say, you know what, we're going to use this adversity to make our products even better. And so we did a tremendous amount of research around how do we take what's already healthy and make it even healthier. And so we launched Beyond 4. Beyond 4 has an incredible ingredient list. It's got avocado oil, so it's considered a heart-healthy oil. It has the endorsement of the American Heart Association from a recipe perspective, has the American Diabetes endorsement, Clean Label Project. So we got all of these tremendous parts of the medical and nutrition community to stand behind Beyond Meat and say, you know what, this stuff is not only really good for you, but we see the consumer saying, you know what, this version tastes even better.
What has been the consumer response? You've actually pulled back on promotions. What has been that consumer response as you've taken some price increases?
You know, we've seen it, I think, be to our benefit. We've got some really good restoration of margin, and that's something that's been important for us. So we went from, I think, a period where we saw significant depression in margin to one now where we're seeing quarter over quarter, it's getting stronger and stronger. And so the consumer's sticking with us, and that's really nice to see.
I remember when the IPO happened, there was this talk of coming out with fish and all these other not strange product, but all plant-based. I mean, where do you want to be? Where is this company a couple of years from now? Is it a portfolio of different products, or you're just squarely focused on beef?
Yeah, so I think my vision for the company remains absolutely the same, and that is to be a global protein company that rivals someday in size JBS or Tyson or these large animal protein. And I think the difference between us and some of the companies you saw around the same time we went public is the social, the health, the environmental factors that propelled Beyond Meat to where it was when we went public are only getting stronger by the day. And so my view is that our best days are ahead of us. We're able to capitalize not only here in the US on some of the benefits we're getting from the health community and nutrition community, the endorsements we're getting from them, but also in Europe where climate is a much bigger issue. So we have a big operation in Europe. We're selling to McDonald's there. We've got both nuggets in McDonald's in Germany as well as our burger. So tremendous opportunity not only here in the US, but also in Europe.
Has the fast food opportunity in the US changed for Beyond Meat?
I think in Europe we're seeing much greater traction with fast food, but I do think that our day is not done here in the US with fast food as consumers begin to really understand the health benefits of eating Beyond Meat as a plant-based meat. One of the things that did happen after we went public is a lot of companies came into the category and they were less choiceful about the ingredients, less choiceful about the health benefits of their products. So as those companies go away and Beyond Meat continues to lead, we're bringing, I think, consumers.
Are they going to go away? I mean, I keep telling you this all the time. I mean, I go into Whole Foods. Yeah. I mean, there's 10, 15 brands I never heard of. They're at the bottom of the freezer section. I mean, they may or may not be meat. I have no clue. But I mean, they're right there next to you. Like, when do they disappear?
So I think what happened is a lot of companies raised money on our valuation 2 or 3 years ago. They're starting to run out of money today. So I think you will see a consolidation in which is good. I think you'll see a consolidation in the category and you'll see Beyond Meat continue to lead.
There's lastly, before I let you go, and maybe this is a two-part one, is when is the company cash flow positive?
Right.
And then two, I mean, there's a lot of focus on how much debt you have and when it comes due, I think it's 2027. What's the resolution? What's the end game for that?
Sure. So I can't give specific comments, but what I can say is that we continue to focus on the most important thing, which is the business fundamentals. And whether it's the restoration of margin, whether it's continuing to bring cash use down, continuing to bring operating expense down, those are the things that are going to propel the business in the future. The debt, as you know, there's restrictions that I have that I can't talk about it, but it's not something that keeps me up. Like what I'm focused on is continuing to grow the fundamentals of the business. I've become a lean convert. I'm very interested in lean management and lean principles, and that's helping us to strip cost out of our structure. The promise that we made when we went into the markets is the promise we're going to fulfill, which is there'll be a day when you can have Beyond Meat at a price that is under that of animal protein. Today, the task we have is to make sure consumers understand how healthy this is, how great it tastes. But over time, you'll see us also be able to address pricing globally. I'm talking in a longer period of time, where we're not only making a health value proposition to the consumer, we're making a taste value proposition, but we're also able to outcompete animal protein based on the long-term fundamental economics of our business.
Good to see you. I can't believe it's been 5 years since the IPO. You still look like the same guy in all the Associated Press photos. It's good to see you. Ethan Brown, good to see you.
Great.
All right, we'll be right back here on Yahoo Finance. Much more coverage of the markets and life and business coming right up.
The Federal Reserve Bank of Philadelphia has begun its search to replace its current president and CEO, Patrick Harker. President Harker's tenure is set to end next June. In a statement, the Philadelphia Fed's board said its goal is to find a new leader who will carry on President Harker's service to our communities and a commitment to promoting a strong U.S. economy. President Harker was named president and CEO of the Philadelphia Fed back in July of 2015 and was reappointed for another 5-year term in March of 2021. Well, switching gears here, Eastside Golf is changing how the game looks. The lifestyle brand today released its Everyone's Game fall collection, including a brand new collaboration with Nike. Eastside Golf was founded just 5 years ago with the goal of driving cultural change in the game of golf, and it's attracted some major names in the process. Beyond Nike, the company has partnered with brands like Bridgestone and Mercedes-Benz USA. And with me now to discuss further, we've got Earl Cooper, Eastside Golf co-founder and CEO. Earl, great to have you here in studio with us today.
Yes, thanks for having me.
I mean, let's talk about this. It's crazy to think that this business was founded just 5 years ago and has the buy-in of NBA champions, of former presidents, and President Barack Obama, DJ Khaled as well. We'll throw him into the mix. I mean, what type of targets has the company really set its sights on now? And is there a business that's scaled itself successfully over the years that you've looked at as kind of a model?
Well, I think, what we've done is we've taken a little bit of, from multiple businesses. You take an everyday business like a Nike and how they reach, so many demographic. And that's one thing we like to pride ourselves on, being able to be at the country club, but also being able to be at the local boutique. So we sell product at Liberty National, which is one of the private top high-end clubs, but then we're also at Fat Joe's up NYC. So it's been great to be able to reach such a wide audience.
What was the pivotal moment for you and for the business and your top execs in really realizing how much impact the brand could have and how to scale it correctly from a business perspective?
Yeah, I mean, I think there were several pivotal moments. Obviously the brand was founded by my business partner, Elijah Jonica. We played together back at Morehouse College, and he created the logo, and it was essentially himself. But I think for us, that moment when Michael Jordan said, you two have two amazing stories. We tell the best stories. Did we sign them yet? That's when it was just like, here's someone that, again, chooses his words, and for those words to have such an impact on us. And it just gave us such a vote of confidence. And since then, we haven't looked back, and we were very grateful, to work with the Jordan brand and continue to work with them.
We're going to talk more about that collaboration and how that's expanded into your newest partnership with Nike as well. But before that, a lot of entrepreneurs, a lot of business operators right now are trying to figure out how they navigate economic uncertainty. And golf is prone to downturns during weak economic cycles because of cost barriers, unfortunately, sometimes. And then you add in consumers already under pressure. These are at the intersection of your business, but how are you posturing the business right now to really navigate all of that?
Yeah, that's a great question. I mean, I think when you look at how we built our business, we like to say we wanted to go as far away from golf as possible. And what I mean by that is that's how we grow the game. And you see that through, our latest collection with Nike called Everyone's Game. And so we're meeting people where they are. This will be the first time that you're seeing golf shoes released in Soho. Right. So again, we're meeting people where they are, and then we're walking them to the golf course, and we want to continue that cycle. So for us, our brand is not just predicated on golf. We want to be everything golf, and we feel like wherever golf is, Eastside Golf should be there. But the difference is that, oftentimes when they launch these campaigns, they invite people to the golf course, and we like to say we meet people where they are.
We were just seeing, and we mentioned this a moment ago, some of the photographs from this new shoe that you've launched with Nike here. And I mean, this is a major collaboration. It's a new era for Eastside Golf and an expansion for the Nike Inc. family of brands here. I mean, what have you learned about partnering with this brand? And what is your advice to other smaller brands who are looking to coexist and collaborate with larger manufacturers and producers?
Yeah, I mean, look, working with Nike has been incredible. Obviously, they have such rich history in golf. This is our first time that you have a performance shoe in golf, and you have some of the world's best players wearing that exact same shoe. I think for us in working with Nike, it's really allowed us to just bring in a new audience, and they've really allowed us to say, what can we do different, and how do we embed storytelling inside of the product? And again, I credit my business partner Elijah, who's also our creative director, in coming up with the story and making sure, again, the technology is very new with the removable swooshes, and that's very intentional because we truly want everyone to feel like you own a piece of this game.
Yeah.
One of the things is we want people to stop thinking that you have to have a handicap in order to play golf, right? Everyone can be a golfer. This is everyone's game. And even if you don't play golf, Eastside Golf can still be product that you wear. I often say, we don't do horseback riding, but we wear polo or Ralph Lauren.
Sure. And so as you're thinking about some of the targets going forward for the brand, what does growth look like from here? And I mean, is there a day where you think about Eastside Golf potentially being a publicly traded company?
Yeah.
And funding? Just walk us through that thought process.
No. So, we have raised capital. We're, again, understanding growth. That's very important to continue to expand the brand. One of the biggest areas that we're looking to expand is distribution. So we've been able to, expand into PGA Superstores. We got our own brick and mortar coming to the airports. Airports have been a very strong market for us. We're also talking to quite a few other golf brands out there as well. So for us, distribution is a big part of expansion. International reach is another big part. When you look at, South Korea, the game is absolutely exploding. We have a distributor in Japan. So it's a wide reach, and we just feel that our message is so unique, and we're uniquely qualified. Sure. We grew up in an environment where most people didn't play golf around us. At the same time, we play golf at a very, very high level. So when you take that experience and you mold that together, it's given us the vision to push forward and to really, reach such a unique audience.
Earl, thanks so much for taking the time here with us on Yahoo Finance. A lot of big events coming up that you've really kind of earmarked for the continued growth of this company and this brand here. Appreciate you taking some time.
No, thank you for having us.
Absolutely. Well, the retail sector has been painting a mixed picture of the consumer over the last few weeks. Strong July retail sales pointed to consumer resilience and sticky inflation, but some retailers have seen a more cautious consumer who's trading down. For more on the retail landscape, we've got Yahoo Finance senior reporter Brooke DePalma live at the Goldman Sachs Retail Conference with a special guest. Brooke, take it away.
Good morning, Brad. I'm joined by Stuart Hazelden. He's our Terex CEO. Stuart, I'd love to jump right in. Your business is global, but you do have a pretty good stake here in North America. What are you seeing? Are you seeing a consumer slowdown here in the U.S. specifically?
Brooke, we're seeing really strong demand across all the regions, in North America in particular. So while we read the same reports that everyone else is around the mixed signals in the economy, we're continuing to see a very strong, robust demand signal, probably more specific to Arc'teryx, as we are early in our growth journey, and we sell a very differentiated premium product.
Yeah. What sort of challenges are consumers facing heading into the holiday and into 2025?
Yeah, certainly, as I said, there's mixed signals in the economy. It's hard to read it. I'm not an economist. And what I would say is our consumer is really resilient. And we are a premium product, not a commodity, really priced at the top of the market in the outdoor space. And we see that consumer in particular as very resilient.
Yeah, I do want to broaden things out. You do have a stake in China as well as Asia, broadly speaking. I would love to understand, what are you seeing in China? Do you think you're immune to the macro trends that we're seeing there of a consumer slowdown?
Yeah, certainly we're not immune. We have a great business in China. The brand is very hot, and we have not really chased demand there in a undisciplined way. We've been very careful with our inventory investments. We have not yet found what I would call the edge of our demand in China. We're not seeing any slowdown in our store traffic and our conversion and in the interest in the brand in China. So again, we're still very early in the growth journey in China as well, and continuing to see a lot of success.
The U.S. election is on everyone's minds. How are you thinking about potential tariffs under our Trump administration?
We have about 20% of our production in mainland China. Our supplier base is very diversified geographically, so we feel good that we can really accommodate any changes in the tariff scenario that you're describing, and really manage the business in a dynamic manner.
You are also opening up new stores. It seems like a pretty rapid approach, somewhat, you just opened one here in New York, in Soho. There's this re-gear option. Can you just break down how you're thinking about store expansion and the potential for consumers to trade in their products? Is that what they're looking for right now?
Absolutely. So we're going to open around 14 brand stores in North America. We see that as a pretty healthy run rate. We probably wouldn't look to open more stores than that. We're really pleased with the economics and the productivity of our stores. We'll open around 30 stores globally. And again, we see that on a global basis as the run rate we might expect to see. And we're really pleased with the productivity of all those locations. Re-gear specifically, as an outdoor company, sustainability is something that's very important to us. Circularity is a central focus for how we build our products, building them to last. We also have care and repair that is a part of the re-gear or the rebird programs that we offer. We're experimenting with resale and a dedicated sales floor in that new 580 Broadway flagship store that you mentioned. We're going to learn a lot from that and look to expand that into the future.
Stuart, I want to tap in a bit to your past. You are a former Lululemon executive. We did hear the company miss on revenue in recent quarter. Do you think that we've hit a peak Lululemon? Do you think that consumers are looking and eager for more and differentiated brands these days?
Lulu's a great brand. I have a lot of friends there, and they're building a great business and continue to do so. I'm not going to comment further on how their business trends are unfolding.
Thank you so much, Stuart. Stuart Hazelden, Arc'teryx CEO. Thanks for joining us.
Yeah,
Back to you, Brad.
All right, Brooke, thanks so much. Appreciate it. Great interview there, and looking forward to more coming from the conference, the Goldman Sachs Retail Conference, with our own Brooke De Palma. Everyone, we'll be right back.
Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. Now, today I'm joined by Brooke DePalma, thank you, and Brian Levitt as well. He is the Invesco Global Market Strategist. Welcome, guys.
Thank
on
you.
the docket, on the docket today, we're going to be talking about two of the biggest drivers of stock prices. That would be earnings and the Fed, and we are in the thick of it on both fronts. We got a Fed meeting this week, and this is the biggest week of S&P 500 earnings, which leads us to our phrase of the day, reinvestment risk. It's a wonky phrase that hails from the bond market. Why you must understand it, keep getting those juicy savings account rates, and they're not going to be 6% forever. And this episode brought to you by the number 99. That is the day count until we get to Election Day, November 5th. Why the Trump versus Biden race is not the biggest concern for investors. So Brian, before we really get into the meat of the conversation, I just want to get your big picture overview of where we are in the markets. We just had a painful rotation, but as I said, it's all about earnings and the Fed this week.
It is all about earnings and the Fed going forward. And we had a very concentrated market for a lot of this year, much to the dismay of many investors. And you saw a little bit of a rotation over the last couple of weeks amid expectations of lower interest rates and a normalized yield curve. What we're dealing with now, we have to be realistic. The economy is slowing. The Federal Reserve rate cuts are priced now. So we've had the three that are likely coming priced. And so you may have a shift back towards a little bit more of a higher quality mega cap portfolio than what you've seen over the last a couple of weeks with this great excitement around the great rotation.
Well, I want to get to our phrase of the day here because it kind of ties into what the Fed is doing, and that is reinvestment risk. And I'll tie it all together, but first, let me define it. Reinvestment risk is a possibility that the income from an investment, like bond interest, will have to be reinvested at a lower rate than the original investment. So you don't get those high rates. This means you might earn less on new investments if rates go down. And this is based on a very simple premise, Brian, that rates are going down, but a lot of people aren't prepared for this because, savings rates they adjust with the flow, with the short-term benchmark rates. So what should people be doing?
Well, people should be looking beyond short rates. If you like a 5 or 6% yield for 30 days, you'll probably love it for 10 years. And so too many people look at it and say, well, I can get this at a risk-free rate, essentially a risk-free rate. Why wouldn't I just do that? And to your point, Jared, exactly, it's the reinvestment risk. And I'll give you an anecdote from my own family. My father talks about all the time in the early 1980s when money market CD rates were 18%, 30-year treasuries.
18.
Yeah, 30-year
Imagine that.
Yes.
Right? And 30-year treasuries were 16%, and he loved 18. Right? So he decided not to go out into 30-year treasuries, and over time, that 18%, had reinvested all the way down to nothing by the global financial crisis. So if he had just locked it in, maybe I wouldn't have grown up in such modest means.
Well, we can get there in a second, but Brooke, you had a question.
Would love to understand how are investors, how do they make the decision of where to go best in this sort of environment? Of course, so I cover retail, restaurants, and consumers are really slowing down there. We've seen some winners like a Chipotle, McDonald's not doing as well. But when you think about where investors should be looking right now, is a CD still a safe place?
Well, the CD is a safe place except for the reinvestment risk.
Yeah.
And so the point is, if those rates go lower, so the risk to the equity market to some extent is a slowdown in economic activity. If economic activity slows, the Federal Reserve will jump in quicker and bring rates down faster. We've seen that in different cycles in our lives. And so investors that aren't taking advantage of the greater than 4% yields right now that
Say
they
a
can
5
get,
or...
in corporate bonds, even U.S. Treasuries, municipal bonds, they may find that as the economy slows, the entire yield curve will shift down. Now, short rates will go down faster, but those 4 and 5% may come down as well. So if you have an income portfolio, it behooves you to think, again, beyond just a handful of days and what the next few years may look like. I'll tell you, in 2019, people were begging me for 4%. And at the time, I used to have to say you had to buy high-yield bonds or you had to lend money to the Russian government. Which one do you want to do? And now you can get it in U.S. Treasuries.
It's amazing because nobody really saw higher interest rates on the horizon. Then you get a pandemic and things can change very, very, very rapidly. We were just talking about how to protect your cash holdings and lock in a rate. What about the investment side? If you're expecting shorter rates by the Federal Reserve, that implies that we're at a certain stage in the business cycle when the Fed is cutting. traditionally certain sectors outperform others. You get into any of that, or is it just press a button and see what happens?
Well, it depends on the macro environment.
Yeah.
Okay, so typically what happens, in a lot of instances, the Federal Reserve is lowering interest rates when a recession has already started. A recession
So the
is,
writing's on the wall, and that's important to differentiate. Because
Yeah.
if the recession is already here, they're cutting 100 basis points.
and that's when you start to get the early cyclicals, you start to get the small cap, the value, right? That's a very different environment than if the Fed sticks a proverbial soft landing. So if we're not already in a recession,
No,
right?
and the soft landing is still the base case.
And I do want to point this out today. A firm CFO told Yahoo Finance, Brad Smith, he said, as long as consumers feel like we're in a recession, it actually doesn't matter if we are. And I thought that
Yeah.
speaks volumes to just consumers' perception of the overall macro environment that we're seeing right now.
Yeah, but usually in a recession, or when you're tiptoeing towards a recession, you see a lot of leverage in the economy. You see a lot of excess. And by excess, I mean businesses have too much inventory. There's too many homes for sale. We're in the exact opposite position. There's not enough business, or at least there wasn't enough business inventory. There's not enough homes. Anyone looking for, there's not enough homes on the
And
market.
prices, forget about it. They're
Yeah,
insane right now. They
so
still
it's-
are.
Yeah, so it's not a leverage excess story. Corporate bond spreads, so the borrowing cost of businesses have not gone up. So it's not a recession environment, but rather it's a slowdown, and things could get worse if the Federal Reserve stays at 5.25 for too long. So if they start to bring down rates and navigate the soft landing, then leadership looks different than if you're already in a recession. And think about 96, 97, like the last time we had
The real soft
landing, it was still mega cap, tech type names. So we've had a little bit of a rotation here, but unless you're going to get a really reinvigorated economy, you may still see larger cap and higher quality outperform, at least in the near term.
To Brooke's point, I think this kind of gets back to Wall Street versus Main Street. And I'm with you, Brian, that I look at the economic data every day. We're not in a recession now, and I don't see that we're on the immediate precipice of one. But there's a perception out there, and I'm wondering how much this perception in investing matters when you have a significant amount of the percentage of the population who think, they look around and they say, okay, we're in recession, things are bad for me. Does that factor into your investment analysis?
Well, people report their own finances better than they report the situation for all consumers.
True.
And, it's like people like their own congressperson rather than they like Congress, right? You look at what's going on, around you, I'm okay, but it's the rest of the country that has
they're not
problems.
okay.
Yeah, they're not doing well. And we have to remember we still have a historically low unemployment rate. Now, you may start to see some cracks in the job market here, but there are plenty of jobs open. Most Americans that want to be employed are employed. You've seen in a lot of cases wages keep up with the price increases. I think what the problem is, the inflation shock has now reset prices. And so every time you go out, you don't feel as wealthy as you once did, even if your wages kept up. And the aggregate data says for a lot of people, their wages did keep up, but they tend to describe it as, well, I earned that, right? And so these prices shouldn't have
But these
done
prices, they're just taking more of my money away now.
They are taking it. But remember, if you are paying it, that's somebody's profit. And somebody's profit becomes somebody's wage, and somebody's wage becomes somebody else's profit. So if you can do that in a virtuous way, which the Federal Reserve is trying to accomplish, then it's, it does not have to be a disaster for the economy. But let's be clear, the Fed wanted things to slow. Things are slowing.
Well, that was a stated objective. It had to.
We don't want 9% inflation rate, and so inflation's in the comfort zone, and now the economy's slowing, just what they wanted.
Yeah, and I do want to hit quickly, this week we have a slew of tech earnings coming out, and when you think about how Americans, how investors should perceive these tech earnings and, translate into their own portfolio, how are you putting it all together? Where should investors really be looking, and how much noise will this create ultimately in their decision making?
Well, there's a lot of these companies that are a big part of the broad indices that people own, so they should be focused on these companies. Now, some, like a Tesla, may be a little bit more idiosyncratic. Those who are competing for supremacy in the artificial intelligence space may have more of a true impact on their business models and the rest of the financial market. So these are the companies, yes, they've been bid up
up quite a bit, but they've also delivered on earnings. And you've seen these companies where they've had significant gains in the last couple of years, but their market valuations have not increased a lot because the numerator being price and the denominator being earnings have both gone up, and they've gone up somewhat in lockstep. So we want to continue to see if this trade continues to work, and ultimately where this AI idea goes, everyone's so focused on who has the software, who has the service, who has the picks and shovels that can bring this to market. The next stage is the market start focusing on who it benefits beyond that, the financial sector, the healthcare sector, the energy sector. So there's a lot of downstream beneficiaries of artificial intelligence and advanced technologies that I think the market isn't even focusing on yet.
Where do you see that, or when do you see that getting priced in? Because AI, in my view, is something that develops throughout into the end of the decade. But so what can we expect in the next year or two? Because the price can get away from hype in both directions.
Yeah, the price can get away from hype. Again, the good news, a lot of these companies have been delivering. What you want to see is, does artificial intelligence take the country to a new level of growth? And, you know, in essence, there's two components of economic activity. There's labor force growth, and there's how productive the labor force is. And if you look globally, there's not a lot of labor force growth. Right, most countries around the world, at least most developed countries. Yeah, we all have less children than we did in the past. And so what you need is the productivity gains. And for people waiting for cyclicals or value, things like energy, financials, different parts of the market to rise to the fore, you likely need a new higher sustainable level of growth. And so that's what we're going to be watching. You know, when I say in the near term, it may continue to be the larger cap, growthier names that outperform, is because we're slowing. Right? The next step needs to be Fed policy plus productivity enhancements taking us to a new level of growth, which will reinvigorate the other parts of the market.
All right, we need to take a short break here. Coming up, we're going to be talking election investing and not getting too wrapped up in it. Plus, the ghost of John Bogle visits us in an all-new Who Wore It Better?
Welcome back. Let's do a quick check of the markets. Taking a look at the Dow, the S&P 500, and the NASDAQ. We had been looking at a rebound across all three major averages. That is losing some steam right now. The S&P 500 and the NASDAQ falling back into negative territory here, down by about 0.1%. We'll round both off to the Dow holding on to gains barely flat, barely to the upside by about 36 points. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. You don't want to miss it.